You're watching the second day of the Investment Markets July 2023 Investor Webinar. Yesterday, we delved into the captivating world of Australian perspectives, where renowned fund managers share their invaluable insights into Aussie companies. Today, we're keen to see the convergence of two extraordinary perspectives, the alternative ESG perspectives and the global perspectives. Brace yourself for an extraordinary lineup of presentations that will challenge conventional wisdom and unlock the doors to boundless opportunities. We are also honored to welcome a special guest, the esteemed Chief Economist of BetaShares, Mr. David Bassanese. At around midday, he'll grace us with an economic update, setting the stage for an insightful Q&A session that promises to expand your understanding of the intricate economic landscape. 10 lucky attendees will receive a copy of his latest book, The Australian ETF Guide: How to Invest More Cheaply, Simply, and Effectively Using Exchange-Traded Funds. Without further delay, let me introduce our first speaker of the day. The founder and managing director of Emit Capital Asset Management, Mr. Matt Dever. The Emit Capital Climate Finance Equity Fund is an Australian unit trust that invests in global listed equities with the aim of reducing or mitigating climate change. The fund follows a thematic strategy focused on climate finance, investing in sectors such as energy transformation, energy efficiency, storage, transport, and related infrastructure, and water management. Its goal is to outperform the MSCI All Countries World Index and generate long-term consistent returns. Matt has over 25 years of experience in energy, clean energy, emissions, trading, and corporate finance. He has worked across Australia, Asia, and Europe in the developing country for climate finance. Welcome, Matt.
Thank you, Angelina, and great to be here today. As mentioned, I'm going to be talking today about climate finance strategies and global decarbonisation. So let's start by defining decarbonisation and climate finance. And it's important to understand the two terms, as the success of decarbonisation relies heavily on climate finance. So climate finance, to start with, is a term given to any financial resource that addresses the impacts of climate change. So typically climate finance is directed towards renewable energy, energy efficiency initiatives, low emission transport, and other emission reduction activities. So climate finance is generated at both the country and business/industry level and can take the form of direct investment, green bonds, project finance, and government-funded support. Now, decarbonisation is the process of reducing or eliminating emissions of greenhouse gas from sectors, industries, and activities with the express purpose of reducing or mitigating climate change. So many countries are embarking on decarbonisation efforts stemming from the Paris Climate Accords of 2015 in an effort to limit the rise in temperature to 1.5 degrees. So hopefully that paints the picture in the context of the discussion today. We're going to move on to some of the climate finance strategies which are essential if the world is to achieve its decarbonisation goals. So a significant amount of both public and private funding is required in the form of climate finance strategies if the world is to meet its decarbonisation goals. This so-called responsible investing is increasing in popularity, with investors seeking to generate both financial returns and generate positive environmental outcomes. So the graph on the right here demonstrates the global investment in the energy transition by sector from 2004 to 2022. As is evident, there has been a significant increase in investment across energy transition technologies and projects. The largest increase has been via renewable energy and electrified transport, with the growing trend towards divestment from fossil fuels. So we're seeing investors focusing on climate strategies as they assess the risk of fossil fuels and seek investments in low carbon alternatives, which can generate attractive returns. So technology is a crucial part of the energy transition and decarbonisation process. Like any new industry or market, costs become a major driver in terms of adoption of new technology. Over the last 15 years, we've seen significant cost improvements in renewable energy transport and energy efficiency technology, providing competition to traditional fossil fuel assets. Examples include advances in wind and solar technology, innovations in battery storage and electric vehicle development, and technologies such as carbon capture and storage and hydrogen fuel cells are also developing rapidly. Industries themselves are also taking the lead as they realise the need to transition to net zero emissions by 2030 or 2050. In particular, we're seeing important technological advancements via the aviation sector, as well as in the high fossil fuel industry of steel production. So these industries are really taking a lead in terms of developing technologies to reduce their emissions. So what are the decarbonisation trends that we're seeing in the global economy? Well, currently there's a significant progress worldwide towards decarbonisation, and the numbers speak for themselves. The growth numbers are quite amazing. For example, global renewable energy capacity is set to expand by 2,400 gigawatts, or 2.4 million megawatts. And to put that in context, the generation capacity of the Australian national electricity market is 54,000 megawatts. So on a global scale, we're just talking about renewable energy, it's a significant increase. In 2020, the global wind capacity exceeded 906 gigawatts, or 906,000 megawatts, and continues to grow. In 2022, global sales of electric vehicles exceeded 10 million, a 50% increase year on year. So really the numbers speak for themselves. The graph here demonstrates the increase in global climate finance over the decade 2011 to 2021. So averaging roughly 7% compound, the increase in climate finance added 480 billion per year over that period, or 4.8 trillion. Excuse me. Now that's a significant increase on an annual basis. However, the interesting aspect of this is estimates suggest that the world will actually need at least 4.3 trillion in annual finance flows by 2030. So that's a significant increase even on what we've seen so far. So what are the trends we're seeing in decarbonisation around the world in the major economies? So I'm starting with Europe. Europe is in some ways a bit of a benchmark when it comes to decarbonisation. The EU set ambitious targets for reducing greenhouse gas emissions and achieving a climate neutral outcome by 2050. Sweden, Denmark and Germany, for instance, have already made impressive strides in terms of decarbonisation, particularly with a focus on renewable energy sources such as wind and solar power and energy efficiency measures. So really, the EU continues to lead the way in this area. The United States, not dissimilar to the Australian situation, has faced significant challenges towards decarbonisation. They've been slow to adopt technologies and policies, and their political system, as I said, like similar to Australia's, is fractured when it comes to climate policy. There are signs of progress, however, in the States. Many of the independent states themselves have set their own decarbonisation targets, for example, California. And the introduction by the Biden government of the Inflation Reduction Act appears to be a game changer for a number of technologies. Turning to Asia, in terms of decarbonisation, Asia has many challenges, not least of which is its heavy reliance on coal for any energy production. Now, as we've seen through some of the charts already, and in the charts to come, China is making significant advances within its industries and society in terms of decarbonisation. That's not to say they're not still developing fossil fuel sources of energy. However, they are, in terms of actual capacity and volume, generating significant advances in decarbonisation. So India, in addition, is a significant developer of renewable energy, and they have a number of energy efficiency measures that they're installing. So Asia is an interesting paradox that's it has enormous potential, but with the developing economies, they still have a number of challenges they must face. So what are the investment opportunities with decarbonisation and climate finance? So as stated by the International Energy Agency, for every dollar invested in fossil fuels, about $1.7 are now going into clean energy. So 5 years ago, this was a 1-to-1 ratio. So the shining example is investment in solar, which is set to overtake the amount of investment going into oil production for the first time, which is quite significant. So quite clearly, investors are recognising the potential of decarbonisation and a shift towards a more sustainable and responsible investment landscape. So turning to renewable energy investment, investment in renewable energy has grown more than threefold over the past decade, outpacing investment in fossil fuels. So solar and wind are now cheaper than coal or gas in many parts of the world. And as we can see here on this graph, it provides the increase in annual clean energy investment in selected countries and regions over a 5-year period, 2019 to 2023. And once again, we can see the largest increase in renewable energy over this period has come from China. Coupled with the US and EU, they account for the majority of the new annual investment in renewable energy. So what are we seeing in terms of investment opportunities in energy efficiency? So energy efficiency investments typically take the form of upgrading equipment and appliances, improving building insulation, and implementing smart energy management systems. All these advancements involve a reduction in energy use and/or energy intensity. As can be seen in this graph, energy efficient buildings have been the majority of investment over the period 2015 to 2022. Industry itself has found it difficult to replicate this, but is showing potential in recent years. The other interesting aspect of this graph is the right-hand side, which demonstrates the significant additional investment that is required in energy efficiency to achieve a net zero outcome by 2030. So what about the investment opportunities we're seeing in the transport sector? Well, we've seen a significant increase in the demand for EVs over the last 10 years, and this is expected to grow exponentially in the coming years. As can be seen in the graph on the right-hand side, which shows electric vehicle sales share by vehicle type and country over a 12-year period. Once again, China is the outperformer in all categories, including cars and vans, buses, trucks, and two-wheelers. The other countries are playing catch up, and we're seeing obviously in North America a significant increase in investment, both in terms of electric vehicles in the likes of Tesla and Rivian, but also in the infrastructure that is required to facilitate the charging of the vehicles. So where is Emit Capital Asset Management positioning itself in the context of these investment opportunities? So we launched the Emit Capital Climate Finance Equity Fund, which is an Australian domiciled managed fund investing in global listed equities. And the focus is on those companies at the forefront of efforts to achieve a net zero outcome. So we invest in the following areas: energy transformation or renewables, energy efficiency and storage, such as reducing your energy intensity, but also looking at battery technology, transport and infrastructure, so electric vehicles and charging stations. And whilst not directly related to decarbonisation, we also invest in water management, which is obviously a byproduct of the whole climate change scenario. In addition, as part of our analysis, we incorporate ESG and impact values scorecards for all individual investments and the portfolio in aggregate, just to add weight to our climate finance focus. Our investment strategy is underpinned by our responsible investment policy and our stewardship activity policy. So what is the future of decarbonisation? So quite clearly the future is both challenging but exciting. So the challenges are the significant investment required to achieve the decarbonisation results that we're seeing, but also to ensure that energy security is maintained. Clearly, the potential benefits of a decarbonised future are enormous, including cleaner air and water, improved public health, and a more sustainable and resilient economy. So with continued investment in technology and policy, we expect to see greater opportunities emerge, and Emit Capital are at the forefront of those opportunities as they arise. Thank you.
Thanks, Matt. Now, in the interest of time, I probably have just one question for you.
Sure.
What role is AI playing in decarbonization of the global economy?
Yeah, thanks, Angela. It's a really good question and very topical at the moment, obviously. AI seems to be on the lips of all investors, and particularly in the area of energy transition. AI is playing a significant role in decarbonisation through enabling innovative solutions, optimising processes, and providing insights to address climate change. So some of the examples of AI application within the energy transition sector include energy optimization and demand management, renewable energy integration, smart buildings and energy efficiency, and industrial process optimization. So AI is key to policymakers and businesses making important decisions on the transition to low carbon outcomes and the allocation of resources effectively. I think it's important also to recognise, though, that AI is just a tool, and it needs to be used with careful consideration in terms of particularly ethical implications and some of the data privacy. But for Emit Capital Asset Management, we're taking a cautious approach to AI, but we recognise that as it develops further, it'll play an integral role in the decarbonisation of the economy.
Thank you, Matt. So great to see you. Have a great day.
Thank you.
Coming next, we have the partner of Federation Asset Management, Mr. Neil Brown, join the call. Federation Alternative Investments 2, F2, provides individuals access to a diversified portfolio of private market investments otherwise reserved for Federation's institutional clients. F2 invests into businesses and assets that meet both economic and social needs, leveraging the team's strength across financials, healthcare, real estate, technology, and renewable infrastructure. Neil is a partner of Federation and leads the investments in George Health, Sendle, and Plenty. Previously, Neil worked at the balance sheet investment arm of Macquarie Bank. He has more than a decade's experience in investment management, and corporate advisory across a wide range of sectors, including energy, infrastructure, transport, financials, and real estate. Neil is going to provide us insight into Australia's energy transition and opportunities as well as the benefits to private equity in a recessionary environment. Welcome, Neil.
Thank you for having me. Thanks for the introduction. My name's Neil Brown and I'm a co-founding partner of Federation Asset Management. As we've heard, I'm going to talk about the opportunity offered by the energy transition in this country to investors over the next decade. But first, to reiterate the overview of Federation, we're an Australian private equity investment business based out of Sydney. The team has achieved a track record of a 22.7% IRR on a set of $4 billion worth of investments exited over a period since 2011. We manage a little over $1.5 billion of client commitments for institutional and wealth management clients across our activities. And as mentioned, we have an existing portfolio of performing assets. Our F2 fund allows wealth management customers to access those investments as well as our future pipeline alongside our institutional investors. We invest in businesses that meet social and economic needs. In addition to private businesses, more broadly across Federation, we have colleagues that manage investments in social real estate in both childcare and disability accommodation, and also in energy transition infrastructure. Our private equity focus is in defensive sectors. We've worked in those sectors for a very long period of time now, including in particular healthcare services, businesses servicing the energy transition, and financials, with a particular focus at the moment on the ageing population thematic. We're a through-the-cycle investor focused on protecting capital in the downside and delivering strong upside potential as well. And finally, we're a responsible investor. We believe that investing in an ESG savvy way is beneficial broadly from a societal perspective, but in the end drives strong long-term returns for our investors. So turning now to the Australian energy transition and the opportunities in this sector over the next decade. Perhaps I'll start by really the driver of the energy transition. And it is one that it is not a policy or political or philosophical driver of an energy transition. It is an engineering and an economic imperative for this transition to happen. The reason for that is that the majority of generating fleet in Australia is provided by coal-fired power stations. And those coal-fired power stations, many of them are 40 and 50 years old and just reaching the end of their engineering and economic life. So they are becoming more unreliable. They're becoming prohibitively expensive to continue to maintain. And so the assets themselves require replacement, as opposed to necessarily this being a philosophical view on wanting to transition away from coal. Having said that, renewables now are already the lowest cost of generation when taken over a lifetime view. And so, again, it's an economic driver to replace the generation that we require with a combination of renewables and storage to provide for the electricity requirement that we have. And then finally, there is a strong policy setting to assist all of that economic and engineering imperative. It has now been legislated in terms of carbon reduction targets under the Carbon Reduction Bill of 2022, and that provides specific requirements to reduce our carbon footprint by 43%. Below 2005 levels by 2030, and also to achieve net zero emissions by 2050. So I guess what I'd leave you with is that it's a engineering requirement for us to replace this generation fleet. The cheapest alternative now is renewables, and they will continue to become cheaper as scale and technological advancement continues. And all of this sits with now a very strongly supportive policy setting to drive that change as well. To give you a feel of the scale, that is a massive capital requirement that Australia will need to attract over that period of time to achieve this transition. The Australian Energy Market Operator estimates that in excess of US $150 billion is required just for replacement of the coal fleet alone. Other bodies, Clean Energy Investor Group, estimates that more than 400 billion is required to actually meet our Paris Agreement commitments. And so that's part of the carbon reduction requirement to meet those requirements. And finally, people will have heard about Australia's hydrogen ambitions as well. And if those are to come to fruition, then that will be even more electricity generation required to do that. So in summary, just a really massive capital requirement and a big task to achieve, not without its challenges, but certainly a huge opportunity set for investors to make good investments within that broad universe. So perhaps turning to how Federation is approaching the energy transition. As I mentioned, we've spent a long time in this sector, but our strategy has evolved by taking private a wind farm development company called WindLab back in 2020. WindLab was probably underperforming in a listed setting from a share price perspective. And we took the view that we were able to take private that business at a valuation that really just reflected its operating assets and the market wasn't valuing the huge book of development options that they have. So we feel like we were able to effectively create that company at a valuation that was effectively a free option over a very large pipeline of wind farm development opportunity. The business did have operations in Africa and it had operations in the US. Our strategy was to really refocus the business back on Australia. We exited the operations in those other countries and actually were able to recover more capital from the exit of those businesses than we needed to deploy to take private the whole business in the first case. In the first place, we've reinvested that capital into the business, built the team. It's now a world-class team of more than 80 team members across development and wind science, grid engineering, commercial teams, and the like. So WindLab is now poised to deploy projects in the order of $10 billion worth of capital required over the next 5 years. And so we're really excited of how that business is now set up to really attack the energy transition opportunity that we have in front of us. As well as that, we have a team that we're looking to deploy into as well. So finally then, to round up on how wealth management investors may get access to this thematic, and there are relatively limited options in this respect, but we have designed our F2 fund for that purpose, to allow wealth management clients to get access to opportunities like these alongside institutional investors. The F2 fund is now open. It provides monthly liquidity. It's widely available on numerous platforms and is researched as well. So thanks very much for that so far, and I'll pause there.
Thanks, Neil. So I got a couple questions for you. First one is, for those businesses that Federation typically invests in, how big are they? And how competitive is it for deals in the Australian mid-market private equity sector?
Yes, understood. We could be thought about as typically investing in companies of $100 to $200 million of enterprise value. And really our bread and butter is identifying companies doing, call it $5 to $10 million worth of EBITDA, and growing those businesses over our investment hold into the $30 to $50 million of EBITDA type of companies. And at that scale, there's then a very broad universe of both global private equity players, strategic players. IPO is a sensible option. So a large universe of exit opportunities for businesses of that scale. And In terms of competition, I would say, there are good mid-market private equity firms who are attacking that sector of the market. What I would say is that more than 60% of the deals by volume in Australia are in that mid-market segment. And so there is a really deep pool of opportunity for us to play in. And we focus in particular on those sectors I mentioned that we've been working in for more than a decade now. And so feel like we are able to find bespoke and attractive opportunities in that very large opportunity set that we're playing in.
Indeed. And you have mentioned that Federation's focus on the downside protection as well as strong equity returns. How is this achieved practically?
In private markets deals, there's a greater ability to negotiate bilaterally and create a bespoke investment. I use the example maybe of our investment in George Health, which was actually an investment made by way of convertible loan. So it was a loan investment that had security over the underlying assets in the business. But it allowed us to convert into equity at a time of our choosing. And really what that means was we were sitting in a very protected position in the capital structure as a piece of credit earning an interest rate over time, but then allowing us to convert into equity when we were certain that our expectations of improvement in value had been realised. And by being able to do that bespoke structuring of that type of investment, it meant we were extremely well protected in the downside, but able to still deliver an excellent return for our investors. Very strong equity returns on that investment as well.
Thanks for that example, and thank you, Neil, for the presentation today. Good to see you, and take care.
And you as well. Thank you.
Our next speaker is Mr. Damien, Group Executive, Sales Distribution from Futurity Investment Group. For the past 2 decades, Damien has been in leadership positions in both emerging and well-established markets across Asia and Australia. Futurity education bonds are designed to tax-effectively save and invest to accumulate funding for education purpose objectives. The flexible structure gives full control and access to funds at any time, both for making education benefit claims and withdrawals for any purpose, including estate planning. Damien would like to discuss how to empower the future using taxpayer investment for generational wealth. Welcome, Damien, Otto.
Thank you, and thank you for those that are joining this session on that. So with that topic and with this covering slide, your wealth and your family, the question is around Futurity Investment Group and what is exactly we're going to touch upon. What we're going to touch upon is education bonds as an investment vehicle, and I'm going to unpack the word education and the word bond. So challenging the audience today to know that this strategy is more than just education or a bond. So let's jump into it. I want to cover some key points around what an education bond is. There might be some myths or some thoughts of what it could be or couldn't be. So I want to take away from the audience, it's not a corporate or government bond, for those that know what those vehicles are. An education bond provides, for those that are with us today, the investors, a versatility option, a tax-effective strategy, but also emerging into intergenerational wealth and estate planning features. So you can see already I'm starting to touch upon a few investment ideas beyond just education or a bond vehicle. Education bonds are a non-super, tax-paid and often tax-free investment and saving strategy. So I'm not going to walk away today knowing that this is not an investment. This is an investment strategy. It's just that we're going to go a little wider than just what returns or what fund we would use to do this. And more importantly, talk about other life events. So the audience might know of family trust as a vehicle to use to invest as an owner. So I'll ask the audience today to think about an education bond as a tax-effective family trust, but not a trust itself without the compliance cost or the 30 June tax returns, but still a vehicle to accumulate and distribute wealth for any purpose. It's just that it's got some unique tax advantages when structured with an education beneficiary or beneficiaries for that perspective. And just from a regulatory point of view, it's important still to know that the vehicle itself, an education bond, whilst only owned by friendly societies, it is under the Life Act and is subject to supervision by APRA. So there's still that regulatory framework around Futurity and education bonds. So I just want to now talk about some core features and strategies around education bonds. For those today might be familiar with some individual characteristics I'm going to talk about, I'm just going to move all those characteristics under an education bond, but advantageous to an investor. So an education bond can act in investment strategy will like estate planning. The features of education bonds, whilst that they sit outside the will themselves and cannot be contested like a will, it can be treated like a will. You can set it up, invest, but also pass on wealth to loved ones that you nominate as a beneficiary. It's a vehicle that you can still use to save or put lump sum monies into. It's not just a set and forget strategy. It's also an investment strategy, again, that even whether you're the investor, or which in this term is known as a bond owner or bond owners, even on the event of your passing, this strategy can be used to future activate transfer dates to beneficiaries beyond possibly the death of the bond owner. I can nominate a time that it can tax effectively go to a beneficiary. There are avenues for tax-free access, again, either built around proceeds going at the end of an education bond investment, proceeds going upon death. There are tax strategies in an environment that the beneficiaries can receive the money tax-free. And finally, on the core bits, tax-paid investing. And an education bond is a tax-paid investing vehicle, meaning the product provider funds the tax on the earnings. The bond owner doesn't lodge a tax file number, and in the main event, doesn't pay tax on a 30 June annual base on any earnings. Quickly though, what cause the benefits of education bonds that capture these and more? I mentioned the ability to use this for education. When an education expense is processed through an education bond, there is a unique 30% education tax benefit. I'm not going to go under the hood too much on that today, but in simple, think of it as a way that when you as a bond owner do process an education claim expense for one of your beneficiaries, whether it be a minor or an adult, there is a 30% education tax benefit coming back from the ATO into the education bond. One of the unique features of education bonds is the access to capital, both in terms of putting more capital in, but more importantly, the flexibility to take capital out for any purpose at any time. So that flexibility for an investor to know I'm investing, but at times when I need it, I can get that money out because I, as the bond owner or bond owners, are in control. That does not trigger a tax event. Most important strategy. Also, the ability to use an education bond for more than just one solution. When we talk about beneficiaries, whether it be children or extended families, to use an education bond, just one strategy, and put multiple beneficiaries under that. So you can disperse monies to multiple people or use it for multiple beneficiaries rather than setting up individual strategies. And I quickly touched upon before the event of death, the ability for an education bond to continue beyond the event of death through a bond guardian feature, that individual overseeing the bond owner's instructions in fulfilling their wishes. Kind of control beyond the grave because the bond owner still is determining how that money is going to be invested and used. The bond guardian is overseeing those features. So that's the kind of mechanisms beyond just the investment that you can use this for in terms of that generational wealth transfer, but in a tax-effective environment. So you're thinking, am I one of those people as an investor who would use an education bond? Obviously, it makes sense that an education bond could be used for those planning to fund for education for present or future children and still access that tax benefit. It could be for grandparents to help families. I mean, in today's cost of living and wanting to start a legacy beyond the death of a grandparent or so, this is a way to start a legacy and help families around cost of living pressures, but also an investment to the future, being their grandchildren, again, in a tax-effective way. Because the vehicle is a tax-paid investing structure, certainly investors on a high marginal tax rate would benefit from this. But also we've seen and heard recent noises around superannuation. So again, an alternative to superannuation planning because of that flexibility. And there are some benefits for those that inherited wealth and want to use it for some tax-effective family education funding, but again, accumulation of that wealth that has sadly been received from an inheritance perspective. So there's some of the personas. So you're thinking our persona, so how does this work? If you're a parent, which on part of the slide shows a parent, John and Mary, or grandparents, in this case, David and Margaret. And then that sits below that is the education bond, and then those beneficiaries that I touched upon, but multiple, whether they are born yet or in the future, the ability to add future beneficiaries to an investment strategy that's already started. So we put some ideas on this slide around how can I use it beyond just the family scenario, because unfortunately in life there are other events that take place, whether it be split families as we touched upon there, divorce, family breakups, whether it be an alternative to wills because of the tax effective structure, whether it just be an extending family and I want to solve solutions for my extended family. I want to invest, I want to accumulate, but I want to distribute in an effective way. I won't take away that there is still an investment menu. Investors, you are still looking for whether I'm a high growth appetite, whether I'm balanced, I'm looking for responsible investing. An education bond sits behind it is a master-like investment menu where you as the investor get the option to align your risk appetite of investments against an investment fund that suits your profile as well. So we've got a range of investments that sits behind the education bond. So if I can just start to close off about the education bond and just remind the investors today, the structure benefits beyond obviously maximising an investment strategy is that control, the control of an education bond whilst alive, but as I touched upon before, even beyond the grave, a great feature for passing on wealth. I touched upon too the ability not to have a tax file number, most likely no tax reporting depending on how you access the funds, and also that flexibility to add future beneficiaries, whether adults or minors, into a bond without restarting it again. The investment menu I just pointed upon before, the education bond under Futurity has currently 32 investment options, but as important as the markets change and you want to change your risk appetite from maybe high growth to balance, you can do that without creating a CGT event. There is peace of mind as the investment if I am using it for education funding, if I am seeking to fund, but also pass on wealth at future to my future family. And more importantly, I've still got access to the funds at any time for any purpose without possibly creating a CGT event. So in my time of presenting today, I just wanted to explore the education bond and more than just education savings plan, more than just a vehicle to create earnings, but the flexibility on how I set that up for myself as an investor or for the family that you're considering to pass on wealth. And I thought I'd just end with a couple stats just to share with the audience. Education itself, when I talk about that portion of presenting and using this for education funding, through our research reminds us whether it's government schooling or private or Catholic, education is not getting any cheaper over that period. So when you're looking to support your families, this is a true cost that's being faced amongst the cost of living pressures that already are in front of people. And I find an interesting stat just recently, as much as there's cost of living pressures there, families are starting to tend towards an increase in sending children to Catholic or independent schooling. And in the years 21, 22, there was actually a small drop-off in students attending government. So there is an importance around education funding and education learning on that perspective. And just that wealth point, we are all living longer, but that means as we live longer and we pass on wealth due to the economic times that have eventuated over past years, the persona of people that are receiving that wealth are parents or grandparents with a long life still to face. So there is wealth certainly sitting in the market. It's a question to the investors, what do I want to do with it now? Or where do I want to pass that wealth on or use it in a tax effective manner? So I'm going to close there as a presentation, obviously putting up a disclaimer to note everyone, but I encourage those to jump on the website of www.futurity.invest.com to explore the education bond for yourselves as an investment strategy going forward. Thank you.
Thank you, Damien. You are very knowledgeable on the topic of education bonds. And I have one question for you. It's a very technical question in a sense. Superannuation are often considered the primary vehicle for investors and to support their retirement income. Now, with both the total balance cap and other possible changes to superannuation in terms of the $3 million balance and additional proposed taxes, are education bonds an alternative strategy?
Yeah, it's probably a key word used there, alternative. I mean, nothing beats super in the context of a vehicle for future retirement and funding of that retirement and in a tax effective manner. But to your point, we are seeing some uncertainty around superannuation being touched on a regular basis. So that regulatory change does create uncertainty. So where the alternative education bonds can sit is where I touched upon that flexibility. Flexibility to continue to put money in, flexibility to take money out in a non-tax manner for any purpose. So complementing the super whilst investing is that vehicle to invest, get a return, but get access to monies or pass on that wealth. And I'll just touch upon estate planning as an additional feature. Maybe sometimes that superannuation certainly can nominate a beneficiary. An education bond can nominate obviously greater beneficiaries. It can be a family trust. It can be a charitable organisation. So just that estate planning as well. So I'd close off by just saying flexibility, estate planning, and with some regulatory changes, uncertainty, an education bond can just give that good alternative to having control, flexibility, but still an investment strategy.
And thank you, Damien. And obviously, just to emphasize, this is not financial advice or financial product advice. So please seek your financial advisors or professional who can provide you advice to consider personal and financial situations before you make a decision. Now, good to see you, Damien.
Thank you.
Take care of yourself.
Thank you.
Our next speaker is Mr. James Brooker, CEO of Social Impact Funds Management. James has more than 20 years of experience in multinational publicly listed companies and has a history of navigating complex regulatory environments and negotiating financial outcomes that benefit all parties. James has been responsible for negotiating commercial agreements between large global corporations, including reinventing global procurement strategies. Now, the SIFM Disability Homes High Yielding Growth Fund number 2 has a target return of 10 to 15%, rents paid by the NDIS and indexed annually by CPI. Units in a fund represent beneficial ownership of the underlying assets of that fund. The unit trust will own a combination of SDA apartments and houses throughout Queensland. The presentation title today is Investing in Specialist Disability Accommodation, SDA. Welcome, James.
Thank you. Who is SIFM? We're a social impact investment fund, which is about making investments intended to have a definable and measurable social impact on the community. We basically focus on sophisticated and institutional investors, which fund purpose-built SDA houses, units and apartments, villas for participants in the National Disability Insurance Scheme that have extreme functional impairment or very high support needs. SIFM is vertically integrated with our SDA provider, NDISP, who's the largest provider in Australia. We have a diverse management team across multiple facets, and the SIFM fund is targeting over 1.1 billion of investment over the next 3 years. Our SIFM Real Estate Investment Trust, which will be the largest national group of SDA properties, is expected to list on the ASX early 2026. What is an SDA property? Well, it's estimated that 28,000 people will require specialist disability housing to be built, and it's growing every year. As a result of the high demand and the undersupply of SDA eligible persons are forced into inappropriate housing in aged care facilities, hospitals, hostels, boarding houses until SDAs are available. The federal government is committed to 700 million annually in payments to SDA property investors for the next 20 years, which is CPI'd annually. Last year, only 250 million in SDA funding was spent on rental payments for SDA property investors, which is only 0.6% of the NDIS expenditure. The SDA market is widely considered the largest social impact investment opportunity in Australia. An estimated of 5 to 12 billion is needed to be invested. The SDA market asset class has quickly grown to be worth over 2.5 billion since its inception, since 2016. Demand being greater than supply and rental funding being provided by the government, SDA investments are risk adjusted and a sustainable investment opportunity that has a measurable impact on our lives for people with disabilities. Who is NDISP? Well, they're the largest private SDA provider who takes lease over the property for 20 years. Participants in the NDIS receive funding to pay for their accommodation as part of their plan, which is typically managed by a plan manager. The funding is paid to the SDA provider for the cost of accommodation. NDISP works with plan managers, other NDIS providers, as well as directly with NDIS participants to provide high quality properties, which participants are happy to call home. They have a team of architects, town planners, and relationship managers as well. So in their pipeline, they've constructed over 160 properties, over 240 registered participants, and another 400 rooms are currently under construction. NDISP SDA properties are built above the minimum standard with Platinum Plus inclusions, with full smart home automation and key central locations to ensure quick lease up and minimal vacancy. Our SDA properties are built like a home and not built like an institution. They also run two other parts of their business called Yellow Card Helpers and Yellow Card Technology. So that's running and looking after the maintenance of all the properties and also the tech that comes with all of our houses and apartments and so forth. This is just a bit of an example of how the money flow works from investors investing into the SIFM fund, then to the SDA provider, NDISP, and how the money flows from the NDIS. So simply, investors invest into the investment fund, which then purchases land, builds the property, raises debt from banks if it's required. The cash flows from the NDIS into NDISP. So they're registered with the NDIS. They design, they construct the property, they take lease over the property, they operate and maintain the property, deals with property management and maintenance issues. So there's, from an investor's perspective, there's nothing else to do. So the money flows back to the investor. So this is just an example of one of the many sort of assets that we develop. So we call them it's a freedom apartment. So we generally do, we always do 2-bedroom apartments, 2 bathrooms. So in this example, a 2-bedroom apartment, high physical support with an on-site overnight assistance. The estimated land and build costs is $4 million, and that's depending on location. So to give you an example of that, is $138,000 per annum per participant. So that's around about $553,000 per year gross income received to investors. So generally, we sort of say a net income of around about 10 to 15% plus capital gain. And a further example is a 6-unit complex we're currently developing in Rockhampton has a valuation of $7.1 million. The government funding allowance is CPI'd for the next 20 years, so that will continue to increase. This is just an example of one of our unit complexes in Brisbane. So as you can see, it does look like just a normal apartment. Obviously, we put rails in and hoists and so forth, but this just gives you an example of how much or how important it is to ensure that everything gets developed as it looks like a home. So the number one is to ensure that everything that's developed has got to be fit for purpose. And we always use a slogan that the participant must be called happy to call home. So our 2-bedroom apartments are all 120 square metres. The doors are 1,200 millimetres wide, where the standard is only 800. 1,500 millimetre hallways, touchless entry, massive bedrooms and bathrooms, auto doors inside and out, auto lift, lights, blinds, fans, aircon, ceiling hoists across the bed into ensuite. Within 500 metres to a shopping centre, and never on a main road. So here also just some truths with SDA as well. So SDA income is not guaranteed. The property is enrolled, not hard based on the minimum standard, but we know that minimum standard doesn't work. The provider must be compliant. It's very easy to register, but hard to maintain compliance. The property requires an approved participant. If the minimum standard, most likely the participant will leave. So the tenants can leave live within 60 days notice, and over 13% living in SDA want to move. And this really comes down to the importance of building something that's fit for purpose that they are happy to call home. So the minimum standard does not work. Meeting the SDA design standards is not enough. One-bedroom apartments do not work. Shared bathrooms don't work. The cash flow sometimes can be lumpy, but we all know that the best property in the best locations and the best inclusions is what works for the participant. Thank you.
Thanks, James. I got a couple of questions for you. The first one is, the NDIA conducted a pricing review effective 1st of July 2023 this year. Now, can you elaborate on the key findings and changes for us?
Yeah, sure. Thank you. So in conjunction with Ernst & Young, late last year, conducted an investigation with the NDIA and reviewed, and this pricing review happens every 5 years. So as we all know, that building costs have gone up, land costs have gone up. So the NDIA made some major adjustments to the income payments from the NDIS. So generally there's about an 18% uplift across the board. And a lot of those areas have brought fully accessible and independent living in line with HPS payments. So that just sort of a larger pond, I suppose, of participants, and also making it more attractive, I suppose, as well for investors. And also things like 2-bedroom houses, which generally was around about $45,000 per participant per year, is now up to around about $85,000 as well. So it has certainly increased a lot. So that was, as I mentioned earlier, that the payments paid out by the government's only reached around $250 million per year, where they've actually budgeted $700 million. So it really shows that undersupply of SDA that's coming through. So this pricing review, which took effect from the 1st of July this year, is very exciting for investors, but also us in the industry.
And we also have heard a lot of news, not all positive news about cost blowouts with the NDIS budget. How does SDA fit into this?
Yeah, so as I mentioned a bit earlier as well, that the SDA budget, I suppose, of $700 million a year is only 0.6% of the overall NDIS expenditure. And it's sort of highlighted as well that obviously that hasn't been met and then hasn't come to that level yet. So yeah, obviously that negativity with regards to the over expenditure in the NDIS certainly hasn't reflected through to SDA, and still makes it a very viable investment opportunity for all investors.
Well, thanks, James. So great to see you. Take care.
Great. Thank you very much. Cheers.
Yes. The last speaker of today's Alternative ESG Perspective is Mr. David Willington, Portfolio Manager of Bombora Special Investments Growth Fund. The fund focuses on quality and unique opportunities with attractive industry dynamics and global addressable markets, backed with strong balance sheets and sustainable funding models. Since inception in June 2018, it has delivered 13.4% per annum net of fees. David has 25 years of experience in the industry, focusing on corporate finance, investment banking, technology, media, and telecommunication. David's topic today is pre-IPO investing, the difficulties and opportunities in the current market environment. Welcome, David.
Thank you very much, Angelina. It's a pleasure to be here and a pleasure to talk to you today and to give you a little bit more of a snapshot around who Bombora is, what we do, and as you rightly point out, what does the current, financial markets and the conditions of those markets mean for where we are and what we're doing. But before I sort of kick off into, I suppose, the market conditions, just a little bit of background on the fund and who we are and what we do. I think the key to the fund is in the name. We are a growth fund. So what we are doing is investing in high growth businesses and providing them with not just capital, but expertise as well to help them on their growth journey and to help them become significant, large listed companies on the Australian Stock Exchange. But just to give you a little bit of an overview of who we are and what we do, we invest in minority positions in high growth, scalable businesses that have got opportunities to scale, not just here, but all around the world. We're about $140 million fund at the moment. The average equity check size that we invest is somewhere between $2 and $15 million. We invest in these, I'd call them scale-up companies. So that's companies that are generally at a minimum approaching $5 million worth of revenue. So they're not startups, they're not pre-revenue companies, they are real companies with real customers, real suppliers, real staff, but have got really big growth opportunities ahead of them. But as I said at the start, need more capital and more expertise to help them realise their ambitions. Essentially, a lot of what we invest in is around technology or technology-related businesses because we find those businesses to be the most scalable, such that they can scale on a global basis without significant amounts of extra capital. So they're capital-light businesses with opportunity that once they get these businesses to scale, then they can actually drop a lot of money to the bottom line. If you look at the bottom left of this slide, you'll see the sort of target portfolio allocation. Essentially, that green section there is what we call actively managed pre-IPO. And in our space, actively managed means we're actually sitting on the boards and driving outcomes within these businesses. And that's despite us generally having a minority position in these businesses. We operate these businesses from day one as if they're a public company from a governance perspective. So we won't do the traditional venture capital or private equity structure of putting a shareholders agreement over the top. We run these businesses as if they're public companies from day one, even though they are unlisted when we first get involved in them. We then, once we've got them ready to list on the ASX, and that's getting them ready, everything from reporting, governance, budgeting, strategy, board reporting, hiring the right C-suite, getting the right board members, we'll get that company ready for an IPO. We will list it on the Australian Stock Exchange, and then we will stay with that business through the early 2, 3, 4, 5 years of it being a listed company and use the capital markets on the ASX to fund future growth and to scale these businesses into meaningful businesses. So as you can see, the green part of the chart there as it migrates into the blue, that becomes actively managed listed equities, whereby we are still on the boards, we're still helping those companies to grow. And then ultimately, once they've reached scale, we will tend to drop off the board and hand our shareholding over to another fund that likes investing in what we'd call passive, larger listed businesses. And we can go and do the same thing again and help those early stage companies to grow and get ready. In the portfolio company examples there, you've got some examples of some of the businesses we have in the portfolio today. On the right-hand side, you've got some active unlisted investments, such as a video production company called 90 Seconds or a fintech accounts receivable management business called Easy Collect. And there's a whole bunch there that we could talk to for a long period of time. But ultimately, our objective is to migrate them into the left side, which is the active listed. There are some of what we would call our graduates, the likes of Beamtree, Janison, Gratify and Madpause, which are now listed on the Australian Stock Exchange. And we continue to manage those businesses and grow them. In the middle down the bottom, what you can see is quite a large and experienced team. that we put into the elbow grease into the active side of the business. What you'll see if you look through the CVs of this is the seven full-timers. We've also got 3 non-executive advisors in the group, which all have 25 years of experience. But across that group, I won't go into them individually, but across that group of 10 people, there's significant experience in private equity, in managing large businesses. We've got a couple of CEOs of very large top ASX 50 companies that have been there and done that. We've got corporate finance, investment banking, broking, diligence, accounting. So the group has got a wide and diverse array of skill sets that we can bring to these companies. Now, what do we look for when we invest in these businesses? I think I've mentioned some of them. These are very high revenue growth rates. I think on average over the last 4 years, we've been growing our unlisted companies 4 years in a row at revenue growth rates of 56% per annum. So these are rapidly growing businesses. They're all scalable in that they've built a technology platform that can now scale, not just here in Australia, but around the world. These are businesses with very high gross margins, often over 80% gross margins. These are businesses that we think have got sustainable competitive advantages and barriers to entry or an economic moat. As Angelina mentioned at the start, we only invest in businesses without debt on the balance sheet. We give them plenty of cash for runway for future growth to handle situations, which I'll talk about at the moment, where the market has definitely dried up for new funding, but our businesses are well capitalised and still have cash on the balance sheet. These are attractive industry dynamics, and we're looking at businesses with really large addressable markets. We obviously do a lot of work around the management team and the culture and the authenticity of management to say, are these people, do they do what they say they're going to do, and do we trust them? And then ultimately, we've got to get involved in these businesses at a compelling valuation, at a discount to the comps, so that we know there's some upside for our investors in the future. You asked about current market conditions and what does that mean for a fund like us? Well, clearly, the last 18 months has seen a significant turn away from the attractiveness or the market's appetite for this style of investing in terms of technology and growth, which is obviously, part of a general market cycle where markets come and markets go. What does it mean for us right now? It means we're probably overweight in the active unlisted space at the moment because we've got a number of businesses that we think are IPO ready in terms of size, scale, maturity, and all of that governance that I talked about earlier. But unfortunately, given where the markets are at, we're not able to list them on the Australian Stock Exchange until the market turns and we can start seeing some more appetite for IPOs in the market. So we're finding that sort of dynamic a little bit challenging at the moment. What I would say is the counter side to when you see investment markets do exactly what they're doing now is there's a massive supply-demand imbalance at the moment in terms of the amount of capital, which is very limited, and the amount of opportunities which there are numerous. So what I'd say right now is we're in one of those unique markets where there's really, really interesting opportunities to deploy capital right now into businesses that are at materially discounted valuations to where they might have been 12 or 18 months ago. And if you're the capital provider that has the capital and has the expertise that we do, you're in a very good position to be able to negotiate really strong, deal metrics on transactions at the moment. As we've seen the sort of capital markets dry up, that does mean that there are a lot of those opportunities out there. We're looking at a number of them right now. In terms of where the fund's at, we're doing a lot of work at the moment doing things like this, Angelina, where we're marketing the fund because we see those opportunities out there. We see there's a very real opportunity for growth and to set this fund up for really, really solid returns in the next 3 to 5 years. So we're spending a lot of time educating our investors and the investor universe that now's the time to be deploying capital into this space when it's in this sort of low depressed state, because if we can set up these sort of investments right now, I can see that we can set the fund up for really strong returns over the next 3 to 5 years. So I suppose in summary, Angelina, that's kind of a little bit about the fund, a little bit about what we do, and a little bit about how we're seeing the market right now.
Thank you, David. You talk about this unique market and this imbalanced supply and demand. And just looking at your presentation slide on the left-hand side, that green part of it, that's the pre-IPO side of things. So I'm just curious, how does Bombora's valuation policy work with these unlisted assets?
Oh, it's a very, very interesting question, very topical. We are a little bit different from traditional private equity and venture capital, although essentially the way they would value their unlisteds is to do a director's valuation every quarter and mark the investments up or down to whatever the valuation that they determine at the time is. We've taken a more conservative approach in our valuation policy. We essentially will do a valuation every quarter of our private investments. If they've gone down in value, we will mark them down. However, if they've gone up in value, we will not mark them up. The only way we would mark them up is if there's an external round of capital that's gone into those businesses at a different valuation to where it is today. So I suppose, where does that leave our unit price at the moment? It's a big question at the moment. As I mentioned earlier, we've got our unlisted companies that over the 4-year period from FY21 to where we see them finishing up in FY24 are growing on average 56% per annum. But we're not in a position where we're able to mark those valuations up until there's an external round of capital into those businesses. So I suppose, what does all that mean? Look, we feel there's some significant latent value in our unit price because we haven't been able to mark a lot of these unlisted businesses up in value despite their growing at such a rapid rate, which is somewhat of a frustration to our existing investors, but potentially an opportunity for new investors coming in. And it's just the way that we've approached the world to be very conservative and not just arbitrarily mark them up in the good times and then have arbitrary valuations. So it's a very topical discussion in our space, but yeah, we've taken a very conservative approach on that.
Yeah, well, thanks, David. It does sound conservative as you only mark down, not marking it up.
Yeah.
And thank you for answering the question. Now, great to see you, David, and thank you for the presentation and the Q&A today.
Coming next is our highly anticipated guest speaker. He's the chief economist of BetaShares. BetaShares is an Australian exchange-traded product manager with $28 billion under management. He's an ex-Federal Treasurer escapade and spent time sipping coffee at the Paris-based OECD. Ex-columnist at the Australian Financial Review and co-founder of a Paris-based Aussie theme cafe. He's the author of Australia's most comprehensive book on exchange-traded funds, the Australian ETF Guide, Cheap and Easy Investment Strategies Using Exchange-Traded Funds. We're giving away 10 copies of this book across to our lucky attendees. Welcome, Mr. David Bassanese.
Thank you. Great to be with you today, and thank you for that very kind introduction. So I think I'll just progress with my presentation today, and thank you for the opportunity. I'm going to talk for around about 30 to 40 minutes on the global and economic outlook. Obviously just general economic information, general economic and financial information. Certainly don't constitute this as personal advice, so the usual disclaimer applies. Let me get straight into it. And look, I'm going to dwell a little bit firstly on the United States economy. It's still the most important economy in the world. The financial market is still the most important one in the world. When Wall Street sneezes, as they say, the rest of the markets catch cold. So what's happening in the US does remain pretty critical for Australia. And firstly, we can see here some, I guess, good and bad news. This is US inflation, the consumption deflator. It's the measure that the Federal Reserve, the US central bank, focuses on in particular. And you can see that as we've seen in Australia and many parts around the world, inflation has surged in the last couple of years on the back of the disruptions caused by COVID, and with hindsight, excess monetary and fiscal stimulus, we really let demand get away coming out of COVID. But the good news, and you can see inflation on this measure, headline inflation, got up over 6%, around 7% or so, and core inflation, stripping out food and energy, got up around just over 5%. Now, the good news in the US is that inflation looks to have peaked. It is coming down, and at this stage it's coming down, almost as certainly headline inflation is coming down as quickly as it went up. If you look at that orange line. Now, one of the I guess, ongoing concerns in markets is that core inflation, as seen in the red line, in the grey line, it is off its peaks but hasn't fallen as quickly. So it's this sticky core or underlying inflation, which is still the lingering concern for financial markets. And basically, and concern here is if inflation remains too high for too long, central banks are worried it will get embedded into inflation expectations, wage and price setting behaviour. And what we'd hope was temporary inflation becomes more ongoing in a way we saw in the 1970s, for example. So central banks are saying they don't want to repeat the mistakes of the 1970s. And so if it takes a recession to break the back of inflation before it gets into inflation expectations, so be it. But we're debating whether or not a recession is needed because inflation, at this stage is at least coming down, but we are still hoping that core inflation there can come down a bit more quickly than we've seen to date. So that is probably the principal major, factor driving global financial markets at the moment. Does the US need a recession to get inflation down, or will it come down of its own accord? And just on that front, just got another slide here. And just with that, we can see this is a snapshot of what's been happening in global financial markets over the past year or so. Firstly, you can see if you look at the US share market index, I mean, look, I'm sure all of you know that the 2022 was really characterized by very aggressive interest rate increases. You can see 10-year bond yields in the US went from around about 1%, under 1% at one point, to up over 4%. On the back of very aggressive central bank interest rate increases to slow economic growth and ideally bring down inflation. That did see the equity market sell off through the first 3 quarters of last year, but we have had a rebound in equity markets since about October, coinciding with a broadly peaking of interest rates, and also helped by the fact that after Russia invaded Ukraine early last year, we got an initial surge in commodity prices and energy prices, which added to the inflation concerns. But perhaps surprisingly, we've seen oil and energy and food prices come back over the course of the past year, which has helped bring down inflation. So basically, and at the same time, as I'll touch on in a minute, the US economy and many economies around the world have not gone into recession. So we had very aggressive interest rate increases. We had a fear of recession building through much of last year, which is why equity markets have fallen. But basically, 2 things have happened following those rate rises. Firstly, global economy has not gone into recession, the US economy in particular, and inflation, as I showed in the first slide, has started to come down. And so markets have been trading on what's called the hopes of a soft landing, i.e. inflation coming down without a recession, until evidence proves otherwise. And that's the sort of situation we're at the moment. So again, the ongoing debate is, can this equity market rebound continue? If we can avoid recession, it will. But if it ultimately we need to have a hard landing and bring inflation down, then this is probably only a bear market rally, and so that's the situation on that front. But so so this is I guess the challenging the case for a recession in the US, the case for another leg down in the equity market, and if you look at the orange line here is the US unemployment rate. and you can see it's very low, around about 3.5%, as low as we've seen going back several decades. The grey line is US wages growth, average hourly earnings, comes out monthly in the monthly payrolls report. And you can see, look, it's come down, but it's still quite high from a long run perspective. So we've got low unemployment, high wages growth. These grey areas are periods of US recession in the past. And you can see that every time wage inflation has accelerated historically and the unemployment rate has reached a very low level, it's basically taken a recession to resolve the problem, to get wage inflation back down again. And once the unemployment rate starts going up, it really goes up by only a little bit. There's a rule in the US, once the US, well, historically it's true that once the US unemployment rate has gone up by at least 0.5%, the economy tends to get weaker and tumble into a recession. And so the unemployment rate eventually goes up by more than 0.5%. And so the idea that, maybe we can get a little bit of a slowdown, get the unemployment rate up a little bit, which will take the edge off wage inflation, help bring down inflation, and we can avoid a recession. That's a really nice hope. But again, it's something that we haven't seen historically. Every time the US has had a so-called soft landing historically on the back of central bank policy tightening, the unemployment rate has basically hasn't gone up. As you can see here in the mid-1980s, the mid-1990s, even in the 2018 when the Fed was raising rates. All these periods of central bank tightenings in the past associated with soft landings, we never saw the unemployment rate go up. And so that is the challenge today is can the unemployment rate stay this low and yet wage inflation come back down again, which is important for the services sector side of things. And just to drill into that a little bit more, that is the case for, I guess, pessimism. And that, ultimately wage inflation is too high, it's underpinning inflation, and we've got to get the unemployment rate up to bring down the wage inflation. But what I've got here is a chart of average and median wages in the US in grey and black on the first chart here, and the US unemployment rate. Now, a lot's happened since COVID, but it bears being reminded that prior to COVID, back in 2019, the US unemployment rate was actually under 4%. It was actually close to where it is today. And at that point, wage inflation was a lot more benign than it is. So it is possible to have low unemployment and pretty benign wages growth. I mean, we saw it as recently as 2019. And at that point, we saw that services sector inflation, if you look at the next slide there, that's core underlying inflation, if you like, in the US, was running at only 2%. Whereas today it's running at 4%. So it's so the problem here is wages growth at the moment still too high, underpinning service sector inflation, which is still too high. So how can we get this down without this necessarily going up? Now, what is the difference between today and 2019? And that's just I can show you it on the next slide. This is a chart of job vacancies in the US. So the total number of reported vacancies, jobs being advertised as a percent of the labour force against the unemployment rate here. And what we've seen is that basically since COVID, or since the collapse in the economy during the lockdowns in early 2020, we've had a period where the unemployment rate obviously in 2020 blew out in the US to about 15%. Vacancies were very low. But we've had an economic expansion such that the unemployment rate has been falling and job vacancies have been rising. Now, the question was, and as a result, we had a very tight labour market, i.e. very low unemployment and very high job vacancies. The situation in 2019 was down here in black, where we had equally low unemployment rate, but lower level of vacancies. So there was less labour mismatch, if you like, in the US labour market. Now, here is the hopeful news, is that what we've seen over the past year is that the number of job vacancies as a percent of the labour force has been falling. We've actually been falling back toward this 2019 situation. So far at least, the excess demand for labour in the US, very high job vacancies relative to available workers, has been narrowing without any increase in the unemployment rate. And so the labour market, so basically businesses have been able to find the workers they've needed. or at least give up on finding the workers they need without jettisoning or letting go of the workers they've already got. So that is a tantalising prospect. If this can continue and we go back to this sort of situation here, we could, very well go back to a 2019 situation. And one of the reasons job vacancies have been falling in the US is that more workers have been fronting up looking for jobs. Labour force participation in the US in the last 6 months or so has rebounded. Immigration, importantly, has also started to pick up in the US. So it's not just a slowing economy that's led to a decline in job vacancies. It's an increase in labour supply and businesses actually finally being able to find the workers that they were after. So that is, again, just to summarise, that is the debate in global markets at the moment. Can we go back to a 2019 situation and avoid a hard landing, or will wage inflation remain uncomfortably high with this unemployment rate so low, such that the Fed would have to conclude we've got to slow the economy, we've got to push up that unemployment rate, because if we don't, then there's a risk that inflation becomes entrenched. For a long time, I was concerned that the US would ultimately need to go into recession, and I still think it's a pretty close call. I think it's probably still a 50-50 proposition over the next year. But I would concede that the grounds for a possible soft landing, given the developments we're seeing here, are strengthening. So it's not necessarily all doom and gloom in markets. We need to see how this situation plays out in the United States. Just in terms of the equity market, so we can see here that the challenge for the market is that equity markets have rallied. So the US share market, you can see here on the first slide, has bounced back quite nicely. So it's more than recovered half its losses. But is now trading at high valuation. So the PE ratio for the market, the price to earnings ratio, has now pushed up to around about 19.5 times earnings, because all of this rebound has come at a time when earnings, this orange line, which is a measure of corporate earnings in the US, have been flattening off. So there's been no earnings growth really in the market over the past year, and all of this rebound in the market has been PE valuations expanding. At the same time, interest rates have stayed at a high level, and so that what this equity risk premium, this is a measure of the valuation of the market relative to the bond market, is pretty expensive. It's just over 1%. Basically, it's around about 1.2%. The long run average of this equity risk premium has been around 3.5–4%. So we're basically less than half our longer run average equity risk premium. So again, it doesn't necessarily mean the market needs to collapse in a heap, because if earnings rebound, if we avoid a recession and earnings start to rebound, and or the Fed can basically pivot and start cutting interest rates as priced into the market, then equity markets can at least hold up, and valuations can this valuation issue can be resolved by interest rates declining and or earnings recovering. But that's what we need to see to justify the market sort of holding up at these levels. And just from a longer run perspective, this is the US market's PE ratio today. You can see here around about 19 times earnings, with a 10-year bond yield around about 4. So in terms of where PE ratios have been historically, with bond yields around about 4%, you can see that we're at the top end of that range. So the market is certainly pricey, even with a 10-year bond yield around about 4%. This was the dot-com bubble valuations in the late 1990s, early 2000s. They're certainly not there. This was COVID, where we had a PE ratio at over 20, but interest rates were a lot lower than they were today. And this is sort of where we sit today. Just in terms of interest rates in the US, you can see here, this is the market's expectations for what the US will do. We've got basically the market pricing in one more rate rise and then aggressive rate cuts through next year, basically 100 points of easing on a 12-month view once we get through this year. Basically, my expectation is that's probably pretty correct. I actually think the Fed will raise rates once, possibly twice more. But as inflation comes down, they can cut interest rates next year such that and I've got the projections here, even allowing for another 50 points of tightening, even allowing for 2 tightenings in the US, this is the Fed funds rate here. Importantly, by year end, I expect the markets to be pricing in 100 points of easing over 24. And then as the Fed starts to cut interest rates, continue to price in further rate cuts through the course of next year, such that 10-year bond yields using my model, based on these expectations, can come down gradually over the course of the coming year. So I think the worst is over in terms of the bond market bond yields as we get in closer to the end of the policy tightening in the US. Now, all of that is contingent on either growth slowing on the back of these interest rate increases or inflation continuing to come down so that the Fed can pivot even if the economy doesn't go into recession. But again, I think there are grounds for so one way to think about it, the 2 most plausible scenarios for the US is either a recession, in which case interest rates will come down, or a soft landing or inflation coming down without a recession, in which case the Fed can also probably cut interest rates next year. So either way, I think the outlook for interest rates is starting to look quite encouraging. In terms of Australia, just a snapshot of our economy. You can see here growth has slowed over the last couple of quarters, but not by enough to actually see the unemployment rate go up. So in fact, we just got an update on this number last week. It was now down to 3.5%. So we've had a slowing of growth, but we still have a relatively tight labour market. We've also had, you can see here, underlying inflation seems to obviously got very high, but the good news is it's starting to come down. A bit like very similar to the US, we have high inflation, but at least it's starting to come down from its peaks. What's also interesting, house prices nationally declined by about 10% last year, according to the core logic measure of house prices. It's a monthly index. But already, just with the hopes that we may be near the end of the tightening cycle here in Australia, we've had a bit of a bounce back just in the last few months, which probably premature, something the RBA wouldn't want to see at the moment, because the RBA ultimately does want the economy to slow somewhat to take the pressure off inflation. Just a bit of a snapshot further on terms of the various inflation measures in Australia. Here is the quarterly CPI in orange. See, the year-on-year rate is 7%. That's for the March quarter. Now, encouragingly, we do get a monthly CPI now that's only been out in the last year or so, and the last couple of numbers are pointing to a further deceleration in annual inflation. The monthly number for May, the annual rate was 5.6%. We actually get the June quarter CPI on Wednesday, and it's likely to show headline inflation annually slowing from about 7 to around about 6, and there's a chance it could drop under 6. So that's pretty good news. Look, if it does drop under 6, I think the threat of the RBA raising rates maybe is again in August will be reduced, but we'll obviously just have to see how that plays out. The underlying inflation measures. You can see the quarterly measure, the quarterly number as at March was at 6.6. Some monthly indicators are suggesting further easing, such that number, when it's reported on Wednesday, could potentially get down to 6 or maybe even a little bit less. So that's the situation on the inflation front. And we look, compared to say the US, we do have a few challenges. You can see here. Electricity prices are going up on the back of the high gas prices of last year, particularly in New South Wales and Melbourne. We've got very tight rental markets, so rents have been going up, and so that is adding to the underlying inflation cost pressures here. So it is a challenging environment compared in some regards compared to say the United States, and at the same time. Capacity utilisation is measured by the National Australia Bank Business Survey. They measure how tight, how close to capacity are businesses operating, and businesses are saying they're operating at a very high level of capacity. At the same time, the unemployment rate is low. So we've got not a lot of spare resources in the economy at the moment, adding to those inflation challenges, which is why growth does need to slow. Just in terms of, I've already showed you the housing. This is from a longer run perspective. You can see that 10% decline in house prices that we've seen. Look, of an order to what we've seen in the past. So if that's the worst, it's certainly a garden variety type housing market correction, certainly not the doom and gloom that many were suggesting last year. And already, tentative signs that the market is bottoming out. And it goes to the point that, at the end of the day, we're very tight. So, we've got ramping up of immigration in Australia at the moment, new building, certainly in areas where people want to live close to the major capital cities, is very scarce. It's a lot of development constraints. And so affordability is very poor, given the increase in interest rates. But there is just the shortages of available housing is just limiting the downside in terms of prices. You can see here just what we're seeing across various states. You can see the bounce has been, fairly broad-based, particularly in Sydney, Melbourne, to some extent Brisbane, Perth a little bit flatter at this stage, but Perth itself never had a major house price correction in the way that other cities did have through last year. Now, so here is the challenge for Australia. We're operating a very high level of capacity, low unemployment. So that would suggest, the RBA has got to be aggressive in continuing to raise interest rates. But at the same time, we are seeing signs of a softening in the economy, and with inflation also easing, the RBA is in this, treading carefully in terms of how much further it raises interest rates. We're seeing business conditions from the NAB business survey starting to ease. Consumer confidence from the Westpac survey, you can see here is at recessionary levels. So consumers are as despondent today as they've been, in past recessions, even during COVID, despite the unemployment rate being at 50-year lows. And that's because of high interest rates pressuring a lot of people with a mortgage, and others, high inflation, hurting the real incomes of many other households. So high inflation and high interest rates have been hurting consumer confidence, helping to slow consumer spending, even though the unemployment rate at the moment still remains relatively low. Other signs of softening, the NAB, this is a survey of businesses' hiring intentions. You can see they've come off. They're still at a reasonable level, but they're certainly off from their peaks. And a measure of job advertisements, as estimated by the ANZ, job ads are certainly off their peaks as well. So certainly not at recessionary levels, but at least past their peaks. So that would suggest that, over the next 3 to 6 months, there should be some slowing of employment growth and some upward pressure on the unemployment rate. And the big driver of our economy, of course, is consumer spending. It's about 60% of the economy. And I've got here in orange is disposable income, and here the dotted line is consumer spending. So it's real consumer spending. So a couple of things have been happening in the last few. So firstly, you can see the collapse of consumer spending during COVID, and then the collapse during the lockdowns that were imposed, particularly in New South Wales and Melbourne, in the second round of lockdowns in 21. So we've had 2 periods of collapse, but in between that, we've had a very strong bounce back of consumer spending, such that overall spending is sort of back to its trend levels, its pre-COVID trend, as you can see here. So that in and of itself would be one reason for consumer spending to slow, in that the bounce back from the COVID-related collapses has restored consumer spending back to trend. The other thing that's been happening, of course, is that the lift in inflation has been hurting real incomes. So you can see here household disposable income has actually been falling since mid-21. Consumers have been keeping spending up because they've been running down their savings rate. So we've had a big build-up in savings during the COVID lockdowns. But you can see since mid-21, consumers have been running down their savings to try to support consumer spending in the face of downward pressure on real incomes due to the surge in inflation. But either way, it's been these two factors, I guess the easing of pent-up demand plus the pressure on incomes from inflation. And I would add also the increase in interest rates that have helped to slow consumer spending. And so it's slowed to a crawl, basically, in the last couple of quarters. In fact, this just breaks it up into services versus goods. You can see that the collapse in consumer spending was most acute in the services sector. You know, the lockdown, the inability to travel, couldn't go to restaurants and cafes and whatnot. So the collapse in spending was a lot stronger for services, and hence the rebound in spending of late has been a lot stronger in the services sector, which is added to the. You can see here, goods consumption has actually been, falling. Now that's because of the pressure on consumer spending generally, but also a switching from goods back into services as we've reopened the economy. So there's a few moving things going on. Overall, consumer spending is slowing, but there's also been a switching from goods consumption into services consumption as the economy has been able to reopen. Just in terms of interest rates, similar story to the US. I mean, I've got the RBA raising rates twice more. And thereafter, you can see the markets are pricing in 2 rate rises and thereafter a pretty flat outlook. I think there's probably a good chance the RBA can cut rates next year after having raised rates this year as the economy slows. And in fact, my projections are down here. You can see even with the cash rate going from 4.1 to 4.6, what's important is that by the end of the year, the market will be pricing in rate cuts in 24. This is what the market expects on a 12-month forward basis. So if the market expects 3 interest rate cuts in 24, as at the end of this year, my model of bond yields, 10-year bond yields, can have them falling back down to 3.5% by the end of the year, and progressively falling all the way back to 3% next year. So again, a bit like in the US, it's an encouraging outlook for bond markets. Although, whether this happens because of a big decline in inflation without a recession, or it is because of a recession, remains to be seen. I'm hopeful that we can now avoid a recession in the US and hence also in Australia. Look, I'll leave it at that. I think that's pretty much my time, but I'm happy to open it up to some questions.
Thank you, David. That was a very good analysis of the global and the domestic economic outlook. And I do have some questions for you. The first one was regarding, again, you talk a lot about inflation and interest rates. So I feel that markets remain fixated on where interest rates are heading, with the global inflation remaining elevated. So do you believe the RBA, the Fed, and the rest of the world's central banks are in control of inflation at this junction? Or some external factors such as energy and supply constraints more likely to influence the direction of inflation rates?
Well, ultimately, central banks, I think, are in control of inflation, not on a quarter-to-quarter basis, but basically on a 1 to 2 year view. If central banks wanted to get inflation down by next year, is an easy way to do it. Painful way to do it, but an easy way to do it is by pushing up rates and sending the economy into recession. So ultimately, yes, I believe central banks can control inflation. Now, they can't control some of the drivers. So one of you mentioned energy prices and to some extent food prices. Now, to the extent there are supply shocks, factors that are pushing up inflation irrespective of demand, that is a very tricky situation for banks, because on the one hand, they, if it's not a demand-driven thing, they can sort of look through it because hopefully it would pass. If there's a one-off increase in oil prices, thereafter they go sideways. Ultimately, the increase in inflation, it drops out of the system. But what they are concerned about is even if it's a supply shock, even if petrol prices go up because OPEC restricts supply, for example, if that leads businesses and consumers to expect inflation to hang around for longer, and they respond by increasing their own prices and their wages, i.e. it gets embedded into inflation expectations, then central banks have to respond. And so even if it's a supply shock, even if it's something that central banks can't control, they need to react to it if they think it's going to get embedded into inflation expectations. So and ultimately, effectively, offset that upward pressure on inflation by reducing inflation in other areas by reducing demand. So there's a few moving parts in that answer, but it's not. Again, some people say, higher interest rates aren't going to solve inflation if it's caused by supply shocks, if it's caused by rising oil prices. No, but what it can do is limit the risk of it becoming embedded in a more ongoing sense by operating on other elements of inflation.
That makes sense. And for me, inflation is a very fascinating and very complex subject. So can you talk us through the process of how inflation becomes entrenched in the global system via second-run wage and price claims? And once it does become entrenched, what are the key implications from an investment perspective?
Yeah, so it can become entrenched. So you can get a one-off increase like inflation took off initially around the world in 21 because we had an excess demand for goods. Basically, if you think about it, government said to businesses and workers, look, we want to limit the spread of COVID, so don't go to the office, don't go to the factory, you can't produce anything, you've got to stay at home and isolate, but we feel sorry about you losing your job, so here's a bucket load of money to go and, spend. And so we had everybody, spending, trying to buy goods, typically online and, having it imported from Asia. So people were buying, furniture, clothes, cars, computers, but there wasn't the supply ability to meet that demand. So, economics 101, when demand exceeds supply, prices go up. And that's what happened. Then we had a reopening of the services sector. And so the excess demand for travel, excess demand in areas like, restaurants and cafes not able to find workers. And so service inflation picked up. So it's been that COVID driver. Now, all of that can get, we saw goods inflation get restored because finally supply did catch up with demand, and demand itself also eased, once people were able to, go and do other things with their money, such as go on holidays and eat at restaurants. But the problem is that initial increase in inflation at a time when unemployment is very low, it hurts workers' real income. I mean, if your income doesn't go up and prices go up by 10%, suddenly you're 10% poorer. Now, if you've got a strong bargaining position because there's a shortage of workers, you can go and demand a wage rise from your employer to compensate. Now, if you do that, businesses may say, well, okay, I can give you that wage increase because I myself can put up my prices to compensate. And all of a sudden we get into this round robin of, wages going up and prices going up, and therefore prices have gone up, so wages need to go up more. And that's how a one-off effect of inflation can get embedded through these secondary effects. And we've seen a taste of that in Australia. I mean, you only need to look at the headlines where, various groups of workers are demanding, and look, and potentially in some cases quite legitimately, because there were wage freezes in place during COVID. So some people didn't get any wage rise for a couple of years, but now they want, a catch-up wage increase. And we're seeing businesses, passing on big price increases as well. So that is the problem. And if it does become entrenched in the way it did in the 1970s, you can get high and variable inflation. And then businesses tend to, once you're not sure what inflation is going to be doing, it tends to cause businesses to, reduce their investment. It causes and reduce their employment, and it's a negative to economic growth. And that's why, central banks ultimately don't want it to become entrenched.
Well, you mentioned the 1970s. So how is the world different now as compared to the 1970s, where inflation was entrenched in the system at that time. What are the implications of those differences for the global economic outlook?
Yeah, there are some important differences. Firstly, if you look at, for example, labour unionisation is obviously a lot less today than it was in the 70s. So workers, generally speaking, don't have the collective bargaining power they had back in those days. So that increase in inflation in the 70s was more easily translated through to higher wages, with unions collectively, striking and demanding wage increases. Globalisation is obviously a lot higher today. Businesses, to the extent there are cost pressures domestically, have a greater ability to source cheaper products from overseas, or even outsource production to overseas if they find that wage increases locally are hurting, are basically making the local production uncompetitive. So in theory, it's harder to get a 1970s situation today because of the greater competition in both product and labour markets. Now, having said that, what we're seeing, inflation is a global phenomenon. So, outsourcing is not as easy because everybody's dealing with inflation. Unemployment is low in many parts of the world. So COVID and the response to COVID, if you like, was a global shock that has left labour markets tight and inflation high in many developed markets around the world. And the other...
Well, except some places like China, though.
Sorry?
Except some places like China.
China's a special case. It's having an economic recovery. It's a faltering economic recovery. But then there are a lot of prices in China are administered. So it's questionable to what extent, the inflation we're seeing is market determined inflation. There's a few other special factors going on in terms of food prices in China as well. But if you look at Europe, Canada, the UK, Australia, New Zealand, all of these countries do have high inflation. Now, what are the implications? I mean, the implications are if we do go back to a 1970s situation, interest rates are going to stay a lot higher for a lot longer. Equity valuations will be crunched down. So there's going to be a negative for the equity market as a result. And ultimately, central banks are probably going to respond by, pushing economies into recession. Well, if they say they will, we'll see, because in the 1970s, one of the arguments is that in the 70s, they didn't bite the bullet and they didn't sort of break the back of inflation quickly enough. Today, they say they will, but we'll see, whether if push comes to shove, whether they do ultimately respond, or do they end up tolerating a higher level of inflation for the sake of at least delaying an economic downturn.
Well, that makes sense. And despite this rising interest rates, unemployment remains low in Australia and in the US. Well, you did talk about the job vacancy comparison and most developed countries. So why has it been so resilient today, and how high can interest rate go before the unemployment trends upwards in a meaningful way?
Yeah, I think, one of the surprise. I mean, there've been so many surprises with COVID. The first surprise, COVID itself was a surprise, of course. The virus hitting us all and then having to go into lockdown. The V-shaped recovery from COVID was a surprise. Many expected the global economy to take some time to recover. The inflation surge in 21 was a surprise. And the fact that it hung around. And now the interest rate increases, and many thought we would tumble into recession quickly. Globally, we've had economic resilience. So there's been one surprise after another. And so why is this resilience? A number of factors. Firstly, consumer, we had pent-up demand during COVID. So if people want to travel again, people want to eat out. And with hindsight, we had excess stimulus. We had a lot of fiscal stimulus, a lot of tax cuts, a lot of fiscal handouts. We had central banks cut interest rates to zero, and many businesses and households in Australia, and particularly the United States, were able to lock in very low interest rates for a long time. So in the US, you can lock in a 30-year mortgage. And so during COVID, when rates were slashed to zero, many households availed themselves of that opportunity to lock in a very low fixed rate mortgage. So it's taken some time for interest rate increases to feed through into the cost of financing for many, because they've locked in their mortgages. So pent up demand, the ability to lock in rates during COVID, excess fiscal stimulus. These are all factors which, in hindsight, we can see has made global growth, so far at least, resilient to the interest rate increases. Now, at the same time, so I would actually think central banks, I think central banks really around the world are probably surprised that we're not in recession already. They're probably, a little bit surprised by that. But at the same time, we've also had inflation coming down. So, funnily enough, they probably thought a year ago that they would need a recession to get inflation down. It's turned out a recession hasn't come, but it's looking, possible that we maybe after all don't need a recession to get inflation down. So that's sort of see how I think things have evolved over the past year.
And the equity markets has climbed a wall of economic worry in recent months as share prices have climbed. Do you believe equity investors have become too optimistic about the global economic outlook and recent bankers' ability to engineer a soft landing? You talk about soft landing a few times.
Have they become too optimistic? Look, I think the way markets work is they rally on the hopes of the worst case being averted. And so far, at least, the worst case hasn't been averted. So the challenge for investors, looking at the market today is, a lot of the good news is already priced in. The PE ratios are elevated. The markets are expecting interest rates to fall. Now, all of that could happen if you do get a soft landing. So if it is a soft landing, then those who invested in the equity market back in late October last year and have been hoping for this outcome, are so far right, and are probably may well be right. But of course, if it is a hard landing, then they'll all be wrong. It'll all turn to tears, and we'll get a second leg down in the equity market. So, as I said, if you seriously believe that a recession is needed to get inflation down, you would not be wanting to wade into the equity market here, because it's certainly not pricing that. But if you think, and again, I think there is a growing hope that the chance that this happens, that a recession can be avoided, and interest rates can be cut next year and earnings can recover, then maybe we won't see as stronger equity market gains over the next year as we've seen over the past year, particularly in the US. But nonetheless, a collapse in the prices is looking less likely in that scenario. And in fact, we may get catch up in other markets like Australia, like Europe, which have lagged the US over the past 6 months or so. So I'm probably neutral on the equity market at this point. I know it sounds a little bit of fence sitting, but I was anticipating a recession. But, there have been some encouraging developments, particularly in the US labour market, as maybe I, laboured over in a good part of my presentation, purely because it is the most critical aspect to the global economy. How that labour market imbalance in the US resolves itself in particular is just so critical to this whole hard landing, soft landing debate that we're still dealing with.
And how do you believe the equity and the fixed income markets will respond once the Fed and the RBA reach the end of this rate rising cycle? Whenever that happens, we're debating who that's probably another two rounds. But
well, again, look, it ultimately depends on why it ends. I mean, if it ends because the global economy crashes into recession, then the equity market, we're seeing historically every time central banks stop raising interest rates because we're going into recession, the equity market might rally on one day because of the confirmation that at least the rate cuts are over, but then it's got to face the earnings declines and the uncertainty of how deep the recession might be. And so equity markets, if it is a recession, rarely bottom, before the recession's even begun. So, whereas for the bond market, all the bond market needs to be confident of is rate rises are over and the next major move in interest rates is down, be it because of a soft landing or a hard landing. So again, either way, that's why I think the bond market is probably the better, most obvious value opportunity in terms of major asset classes at the moment, because either a soft landing or a hard landing is okay for the equity market, whereas for the bond market. But obviously for the equity market, a hard landing won't be okay. A soft landing will be okay, but again, you're probably not looking at super fantastic returns of the order that we've already seen. So how markets respond to the end of Fed central bank tightening, ultimately depends on why they end it. If they end it because of recession, or do they end it because there's no recession, but inflation is coming down nicely and wage inflation is coming down nicely.
And that will be a pretty good situation, right?
Fingers crossed.
Yeah, fingers crossed. And are there any non-consensual economic outlook scenario investment markets are dismissing as unlikely that you believe warrant greater attention?
Yeah, for sure. I mean, the pain trade today, the pain trade really over the past 6 months or so has been to be underweight equities, believing a recession is coming. And so far, at least that hasn't happened. So that's been the pain trade. The pain trade now might be that we do get a rebound in energy and food prices. We've seen oil prices tick up in the last few weeks. We've seen Russia starting to restrict supply. Now they've also ditched their grain deal that allowed Ukraine to export a lot of food to parts of the world. And if food and energy prices back up over the next few months and headline inflation starts to back up from what is already a very high level, that will be very painful for bond and equity markets. So that is a non-consensus, something to certainly look out for.
Well, to conclude, can you please share a game-changing lesson you've learned this year in your position as BetaShares chief economist?
Sorry, can you say that again?
Can you share a game-changing, lesson you've learned this year in your position as BetaShares chief economist?
Look, I think the lesson learned, COVID has just been a series of very challenging environments for macroeconomics. It's been a sort of shock to the system that we haven't seen in history. Maybe have to go back to the 1915 Spanish flu situation. But I guess what I've learned is how resilient economies are to higher interest rates. That has been the big surprise packet over the past really since late last year. We did fear the rate rises would cause a recession, but so far it's not happened. So you've got to be open-minded to economies being a lot more resilient than initially expected.
That's so true. Well, thank you, David. It's so wonderful to see you. Take care.
No worries. Thank you. Thanks for the opportunity.
Now, our first speaker from the global perspective is Mr. Dave Allen, Plato Investment Management's head of long-short strategies and portfolio manager of the Plato Global Alpha Fund. The Plato Global Alpha Fund is a long-short global equities fund dedicated to proving investors all weather investment solutions that can generate alpha throughout the cycle. The team isn't mandated to stick to a particular style like value, growth, or quality. Instead, the fund is focused on generating consistent features so those in the accumulation phase can grow their assets over time. The fund aims to outperform the MSCI World Net Returns Unhedged Index by 4% per annum after fees over the medium long term. Prior to Plato, Dave worked for JP Morgan Asset Management in London for 15 years, where he designed and launched the JP Morgan Euro Equity Plus Active Extension Fund, which grew to 6 billion euro. Today's presentation topic is shorting the losers and backing the winners. Plato's all-weather investment strategy. Welcome, Dave.
Thank you so much for having me on. I really appreciate it. So the fund that I'll talk about today is the Plato Global Alpha Fund. So this strategy has a MSCI World benchmark and is suitable as a core allocation for your equity exposure or a satellite allocation. What's really distinctive about this strategy is it's 150% long and 50% short. What does that mean? Well, it means we've got 50% more firepower for our best ideas, but we've also got 50% short that gives us the ability to make money through the companies that are going to underperform. And in this environment where rates are going through the roof, companies that have been limping along and never making a profit are really being found out. The performance to date have been very strong in last year's value-dominated market and then this year's growth-dominated market. We're actually outperforming the MSCI World by almost 9% per annum since the strategy was launched. If we look at the performance, as we alluded to, of strategies that I've run in the past, we have the active extension strategy here on the left-hand side from my time at JP Morgan, where over a decade-long period, we outperformed by about 4% per annum relative to the MSCI benchmark. On the right-hand side, this is a long-short, actually a market-neutral hedge fund strategy where we generated an annualized alpha of around 10% per year. So we have a fantastic Plato, we've got 10, 11 billion of assets under management, and we're sort of known and loved for the Australian income strategy. But what many of you may not be aware of is we've got a tremendous depth of talent in global and global long short. George Platt, of course, was the head of the Macquarie hedge fund group for many years. Charles was largely his right-hand man. And we have Don, the Dr. Don, of course, launched Australia's first ever 130-30 strategy when he's back at State Street well over a decade ago, and Chanel as well with extensive long-short experience. And they're the faces that are really driving the performance that we've delivered so far. The key investment philosophy behind everything we do is a company for us to invest. It has to be a high quality business, but high quality businesses, the market's quite efficient and they'll tend to trade at a premium to the market. So we're looking for those high quality businesses that for some reason the market isn't really accounting for that value correctly. Of course, cheap names can remain cheap for 5-10 years. Good being right if you're right 5-10 years too early. So we'll always wait for those cheap, high quality names to have that profit potential to be unlocked with some sort of a catalyst or a change in sentiment. The final hurdle that a company must overcome for it to make it into our portfolio is a system of over 100 red flags that we've developed for almost a decade. The red flags is one of the most distinctive parts of the Plato investment process. Really, the red flags are about avoiding landmines and also identifying great short opportunities. So if we see a cluster of red flags where a company has weak governance, signs of financial distress, really aggressive accounting, then those companies we really try and steer clear of. If a company has 8 or more red flags, then that company on average will underperform the benchmark by about 20% over the next 12 months. So it's a pretty substantial number. If you can just avoid those blow-ups in your portfolio, you're halfway there. But if you can go one step further and short those names, then you can generate some fantastic alpha. And indeed, 90 to 95% of the alpha that we've generated on the strategy to date has actually been on that short side. There's some really interesting names globally and in Australia at the moment that have a very large number of red flags. So BrainChip, this is a company that has 22 red flags, and that out of the 10,000 companies we look at globally, it's the second largest number of red flags. And it's a company that had a valuation around $3 billion around the start of the year. And this is a company that's got less revenue than some cafes. So there are a wealth of opportunities out here. I think it's almost a once in a lifetime opportunity for shorting strategies to make money on these sorts of names. On the long side, though, there's some names we really like. BMW is a great value company. You know, it's incredible to me. Such a storied name can trade at 6.5 times earnings. And they've got a huge amount of growth, even in their EV space, growing at 35% per year, which is the same as Tesla. We look to drive really consistent returns by having the very best value names, the best growth names, and the best quality names in the portfolio. So not tied to any one thematic or one style. A great growth name that we like in the portfolio is Novo Nordisk. Of course, they're at the forefront of the anti-obesity drugs, 80-90% market share in that. ASML, they're at the very apex of the semiconductor supply chain. They actually make the machines that make the chips that are behind all of the most advanced AI. So whoever wins that AI race, ASML will win irrespective of that. And by having those exposures to some of these great companies that I've personally been invested in for well over a decade, we can drive consistent returns and not the feast and famine returns that you've seen from some highly concentrated managers. And that's exactly what we're seeing here. The outperformance of the strategy since launch is almost 9% after fees. But I think equally gratifying, if you look on the right-hand side, the upside and downside capture of the strategy. So the upside capture is about 1.25. So that means when the market's going up, we're going up more than the market. The downside capture is about 0.8. So when the market's going down, we're preserving capital better than the market. So that provides those nice characteristics we like to see as investors. That's translated to very consistent returns over time. This shows the performance of the strategy compared to the 40 largest competitor funds, and you can see that we've added alpha consistently in a pretty difficult period for investors with lots of different themes. So what are the key takeaways? That we can deliver that high alpha as we've done here and in past lives, but without that high concentration and those severe drawdowns. The focus really on that all-weather performance, whether it's a recession or whether it's a growth market, where we're not looking to make excuses, we're looking to make returns irrespective. The red flags are absolutely critical within that to A, avoid landmines on the long side, but B, really drive alpha on the short side. And ultimately, that's all contributed to some very strong performance in quite a challenging period for markets. Are there any questions that you'd like to go through?
Yeah, thanks, Dave. Absolutely. There are a few questions here. The first question we have is around AI. So we know that there is a lot of hype surrounding AI at the moment. So how are you looking at AI? And the second part of the question is, any more broadly, how do you play these thematics that emerge from time to time with so much hype?
Yeah, I think it's an excellent question, and many people hadn't even heard of ChatGPT until last November, and now it's upending almost every industry you can think of. In such a rapidly changing space, I think it is difficult though to pick the eventual winners downstream. So it's very much our philosophy that you want to have more of a picks and shovels approach, where you're investing right at the apex of the supply chain. So ASML is the name I mentioned just earlier. They make the deep ultraviolet lithography machines that are critical to every single AI process in the world. And that's a way that you can get access to the thematic, but without taking on too much idiosyncratic risk as the landscape changes from week to week and month to month.
That makes sense. And can you touch on why you do think investors should consider allocating to a long-short strategy as opposed to just all long only?
Yeah, like another good question, I think. Outperforming consistently with a purely long-only strategy is difficult. If you want to generate income long only is perfect. It's the perfect vehicle for that. But if you want to generate alpha, long only is almost like going to war with a water pistol. It's hard yakka. Say that you identify that a company's fraud, all you can do is not hold it. But the second you can be long short, you've taken off the handcuffs and you can generate a huge amount of alpha on the short side. And this environment where there's a lot of dispersion between your winners and your losers, companies are being found out that had lofty valuations that are being torched by rapidly rising rates. It's a great environment for long short, without a doubt, and we've definitely had that tailwind behind us in generating the strong performance that we have.
Well, thank you, Dave. It's great to see you. Take care.
Thank you so much.
Our next speaker is the founder and CIO of Swell Asset Management, Mr. Lachlan Hughes. The Swell Global Portfolio is a carefully selected portfolio of international equity investments listed in developed markets. The principal objective is capital preservation. Therefore, there is a greater emphasis on preventing losses than reaching for higher returns. Lachlan founded Swell Asset Management in 2014. He is a CIO with responsibility for investment decisions. Lachlan's career spans over 22 years in legal and analytical roles with 15 years in investment management. Previously, he worked in Nova Port Capital, Kin & Wood Mallesons, the Bank of New York, London, and Alco Finance Group. Lachlan is going to discuss the Swell Global Portfolio. Welcome, Lachlan.
Thank you very much, and thanks for joining this presentation. In the interest of time, I'll let you read the quote and the disclaimer and jump straight to our business roadmap. So as you can see here, Swell was incepted back in 2015, and we have an 8-year track record now, but in many ways, we really feel like we're just getting started. I actually started my career in law, as you've already heard, and moved into funds management in September of 2008, which was the week after Lehman Brothers collapsed. And I learned a lot through investing in this period, but it showed me, if I cast my mind back to that time, I would have thought that the GFC was the worst financial event that we would encounter in my lifetime. And then roll forward 15 years, and today we've seen, just in the short time, the 8 years that Swell's been around, we've seen a global pandemic, we've seen war break out in Europe, we've seen record inflation and record amounts of stimulus. So I think that the key message is the world is always uncertain. In fact, it was even uncertain in December of 2019 before we entered the pandemic. We just didn't realize it. So when people expect things to be uncertain or feel uncertainty today and expect more of the same in the future, it tends to be a good time to invest in the markets because generally when there is uncertainty, prices are lower. So it's worth keeping that in mind. Now, the way to overcome this uncertainty is to have a process, a clear process for identifying companies and investing in them. And that's what we have here at Swell. Now, these 3 bullet points deal with the who is Swell, but what I would like to do is tell you a little bit about the why is Swell. And to do this, I need to take you back to the 1950s and the birthplace of modern portfolio theory. And basically, this is where diversification was born. And what started with noble intentions brings us to a point today where 90% of fund managers are underperforming their benchmark after fees. Now, there's a good reason for this. And the reason is, as you increase diversification, yes, this is good from a diversification standpoint, but if you add a stock of lower quality, you're actually lowering the quality of the overall portfolio. And this is why at Swell we focus on concentration and quality. But look, we've borrowed this from the super investors. If you look at Warren Buffett, Charlie Munger, Seth Klarman, all of these super investors adopt a concentrated approach because it is the only way to beat the market over the long term. Now at Swell, we help two types of people really. The majority of the people we help are busy executives and business owners. And the common characteristic they share is that they are time poor. And because of this, the most important thing for them is to get trust in the person who's managing their money. And the way that we help them with the trust component is to invest alongside our clients. I have more than 90% of my net worth invested in the Swell Global portfolio, and this will always be the case. And the second part is we want to be really transparent about the way we manage people's money. And I feel like we do a good job of preparing them for what they can expect investing with Swell. Now, Swell philosophy is based on 4 simple principles: quality, value, conviction, and horizon. But quality is the first aspect of this, and I'd like to talk to that a little bit. We want to find companies that we understand. Being able to understand them is very important, and they need to be earning an attractive return on their invested capital. But more than that, we need to have companies with a strong moat or competitive advantage. And it's more important, it's obviously important to know what the moat looks like today, but we really want to know what this moat's going to look like in 5 or 10 years' time. And you can only do that with certain companies. So whenever we identify a company, we really want to look into the future and see, what does this moat going to look like in 5 years or 10 years' time? Once we can make that decision, the rest of the process tends to follow. And obviously the value component, we need to purchase these companies at a discount to their intrinsic value, conservatively stated. So that's why we say we're a value investor. And the last 2 parts, conviction I touched on, but horizon, this is where we adopt a long-term view. Now, how do we differ from our peers? We seek to own 10 to 20 high-quality companies. And as I said, stock concentration provides the best opportunity to beat the market, and empirical research supports this. Excuse me for a second. If we have a look on the chart on the right, this is all funds, and these are diversified funds, produces over this, the extent of this study, around 10 years, the average return of all funds was 6.3%. But had we taken their best 10 ideas, excuse me, if we'd taken their best 10 ideas and invested them from their current portfolio into the best 10, they would have lifted their performance by more than 3%. So what this tells us is traditional funds are not doing a bad job. It's the system in which they're forced to operate. Having too many companies makes it very hard to beat the benchmark, because the more you add, the more you replicate the benchmark. And if you take out fees, that leads to underperformance. So the way to beat the market over the long term is to take a concentrated approach. Now, while concentration makes a lot of sense if you're getting your calls right, it makes absolutely no sense if you're getting your calls wrong. So what this chart on the left shows is, that Swell's concentration is around 10 to 20 companies, but we actually get 66% of our stock calls right, and that compares to 50% for our peers. So that's our hit rate. It means in every 10 companies that we look at and invest in, 6.6 will be right. And that's the first piece of the puzzle. The second piece of the puzzle is ensuring that those stocks you're investing in are producing a payoff that's attractive. And when we calculate our payoff versus our peers, it's almost 2x our peers, 197% payoff. So Swell's getting the stock calls right at a higher rate than peers, but also investing in the right types of companies. Now, I mentioned before about playing the long game, and this is incredibly important for us here at Swell. So we focus on the long term, we remain true to label on that point, and this is borne out in our average holding period, which is 2.86 years versus our peers at 1.37 years, so more than 2x our peers. And the real challenge investing in the long term is holding the companies that have performed well. But a good example of a stock that we've owned since our inception in 2015 is the company Microsoft. Now, Microsoft's up nearly 7x since we purchased it in 2015, so it's appreciated a lot. And there's been many, many times throughout this period where we've been encouraged to sell the position, where people were fearful about the future, but we've managed to hold the company the whole way through. And you can see when you buy the right companies, like Microsoft, even with the pandemic, even with the war in the Ukraine, the good companies continue to go up. And I think a forgotten element of investing in a concentrated way is it's important to focus on your defenses. So we focus all of our attention, or 80% of our attention, on the companies we own today. We want to know them better than anyone in the market, and to understand the risks, you need to focus on them. And this has been a very good thing for us. If we take a company like Meta was a really poor performer in 2022. But because we knew the company exceptionally well, we felt comfortable in lifting the position of the Meta within the portfolio during a time when the market was very negative. And this has produced like a fantastic return for us in 2023. But it does go to show that when you're investing in a concentrated way, you must focus on your defense. You must focus your time on the things you own, because that is where the biggest risks will be in the portfolio. And finally, I just wanted to show you the Swell Global Portfolio logos. They're all very well known companies, and they span a wide selection of industries, whether that's agriculture with John Deere, whether it's healthcare in a company that like GE Healthcare, which makes MRI machines, or companies like Google, Microsoft, or Amazon, and then the big investments they have in the cloud today. So you can still get diversification with a small group of companies, but the key is focus on the companies and you'll do very well over the long term.
Thanks, Lachlan. Now I have a couple of questions for you. So first one is, can you describe the process you follow to select the top performing companies for your portfolio?
Absolutely. So we follow a very traditional process here at Swell. So we start with a stock screen which identifies about 5,000 companies. Then we do a little bit more work on those stock screen and we bring it down to a group of 500 companies. But the real work starts once we've identified a stock from within that group of, say, 100 companies. We put it through a preliminary checklist which goes through a number of factors that we think are very important to how this business is going to perform over the long term. But the real point of difference from our peers is we will spend upwards of sometimes 300 or 400 hours identifying and working on a company before we acquire it. And that's really our point of difference. We've got to know the company very well to understand what that moat's going to look like in 3, 5, and 10 years' time. You have to do the hard work at the start. So we spend hundreds of hours looking at these companies. And then once we've progressed through, we'll build things like we do a detailed financial model, which includes a balance sheet, income statement, cash flow statement, but also a very detailed qualitative compendia document, which goes through all the key points that we think we need to understand prior to investing. And very few, I think the point we'd make is that very few companies make it through the process. It's only the small select group that can meet all of the tests we have in place for our companies. So look, I say it's traditional in the respect that we are researching in the same way as other funds, but we're doing this at a much, much deeper level.
Well, one more question for you. Last year, I hope you don't mind asking you this, your performance was under pressure. So how did you respond to that?
Yeah, last year was a really tough year for technology investors, and the way we responded is to follow the process. We doubled down on the process. We did exactly what we'd done previously. We made sure that in companies that had fallen, we redid the work, we had a look at them, and where they were attractive, we increased the position weights, and we did that with lots of these companies. So what we found is, as we moved into 2023 and people became more optimistic about these companies, they've rallied back. So, an interesting point would be a stock like Meta, which fell from $300 to $100. Well, it's back to $300 today. Now, all the things which had that stock falling last year, it really was, the stock was very hard done by last year, and then got into this spiral of negative news. But if you understand the stock, you're not as fearful, and we really take advantage of those things. So in tough periods like last year, we followed the process. And I really think we've kind of vindicated that approach in 2023 as we've had very strong performance this year.
Thank you, Lachlan. Good to see you. Take care.
Thank you.
Coming next, we have the Executive Director, Head of Distribution and Operations, Chief Investment Specialist of Premium Asia Funds Management, Mr. Jonathan Wu. The Premium Asia Fund aims to generate positive returns consisting of both capital growth and income over a 3 to 5 year period prior to accounting for movements in currency exchange rates by providing exposure to the Asia ex-Japan region. The fund is denominated in Australian dollars and typically will not hedge its currency exposure. Jonathan was named the Young Achiever of the Year 2013 by Money Management for his work and passion in the financial services industry. Jonathan is going to give us a review of how exposure to Asian investments can provide a low correlated addition to your portfolio. Welcome, Jonathan.
Thanks, Angelina. Thanks, Investment Markets, for the opportunity. So what I'm here to talk about today is effectively how an investment or an allocation in terms of your investment portfolio in Asia, which is, genuinely very much underexposed for Australian investors, can provide an added alpha, but at the same time, it can provide a low correlation exposure to help you diversify your portfolios and get you absolute performance. So I'm going to sort of walk through that with you today. Obviously, disclaimer, everything I say today is general in nature. Obviously, if you want further information, it's best to go seek advice from your financial advisor, or if you're self-directed, then please refer to our product disclosure statement as well as our target market determination. So I guess in terms of the macro environment, one of the big questions that we're seeing and being asked is, if we're going to go into a recession, okay, and one of the key drivers of that recession is because interest rates have gone up quite significantly. Effectively look at Australia, we've effectively gone from 0 to over 4% in under 15 months. And so as interest rates are increasing, as we all know, it's starting to bite. Now, one of the key things is that when we then look at an environment where structural interest rates are higher than where they have been historically, especially in the last 10 years, in a no inflation printing money type scenario, as we come out of this, which of the major economies has the ability to be able to spend harder and stronger and in a more sustainable way? And what you see here on this chart is effectively the savings divided by GDP for both the US and China. And what you can see here is that the Chinese household actually has more savings than the entire size of its economy, whereas the US is actually only half of the size of the economy is actually in savings. If we then consider the level of household debt, then the US has actually got more household debt than the Chinese. But if you actually overlay those two numbers, so household debt minus savings, the US consumer actually is in net debt. Whereas China, they're actually in net savings. So as we go into the next 2 or 3 years, if you consider who can actually spend their way out of recession and build up a strong recovery, China is actually the place to be. Just a quick introduction on our fund manager. So our funds management team is based in Hong Kong, and we also have offices in Shanghai, Shenzhen, Kuala Lumpur, and London. And one of the key strengths of what we do is that we're one of those homegrown brands. We're not a brand that is from the US or from Europe. We're based in Asia, we're founded in Asia, and we manage around $6 billion US. So one of our key advantages is we're not all that excited to grow assets under management for the sake of growing it. We want to provide the alpha because, as we know, as fund managers get larger and larger, one of the biggest problems that they have is that they asset gather, and their ability to actually be nimble in the market actually lessens over time. So what we like to do is we like to have a big, strong team of investors based right across the region, but manage a small amount of money to deliver the alpha for you as investors. And the best way for us to do that in a region that is relatively more opaque than, say, Europe, Australia, or the United States is that we focus on company visits. We don't trust anyone's external research reports. We only trust our own visits. And we do 6,500 of those company visits a year across the region. There is no single asset manager in the world, no matter how big they are, that can compete with us in terms of just looking at the Asian region. Now, at the end of the day, the proof is in the pudding. Our Premium Asia fund has been around since December of 2009. And what you can see here is that we've generated over 200 basis points of alpha, or 2% above the benchmark after fees. So, one of the key things in our family office that we're very focused on as well is that we only care about after fee performance, which is what you see here. And furthermore to that, in 2019, we dropped our fee significantly. And you can see here that year on year, we have provided that alpha that investors are looking for in a sustainable way by investing in Asia. If we then look at our peer group as well, you can see that besides being the 3 annualized return, we are a second quartile fund. We are top of the pops in every other single time frame, all the way back to inception. And you can see that our excess return, we have always, no matter how many years you're looking at us, we have outperformed the benchmark significantly. So this goes to the correlation argument that I mentioned earlier. And correlation is very, very important when you consider how you construct your portfolios. Because if you, say, for example, buy an Australian equities manager, you choose a growth manager, you choose a balance manager, you choose a value manager, and you put them together, you effectively bought the whole market. And you might as well, by that point, actually just have bought the index. So when you look at Asia, and what you can see here and how to read this chart is that you can see that as the pyramid goes from top left to bottom right, you can see that it's always stating 1.000 because that's a perfect correlation. So what does 1.000 mean? It means that if the S&P ASX 200 index moves up 1%, then the same index will move up 1% as well. So the lower the number, the better it is in terms of diversification. What you can see here is that for the Premium Asia Fund and the Premium China Fund, against pretty much all markets, including Australia, including the US, including Europe, you can see that the correlations are getting down to about 0.2. And 0.2 effectively means that when the market goes up 1%, our fund, statistically speaking, will go up 0.2%. If the benchmark goes down 1%, then our fund will fall 0.2% statistically. So you want to be able to blend a portfolio with different assets to be able to give you that diversification. So now that we're moving on to the fact of where we sit in terms of the economic state globally, one of the biggest concerns is what's the ability for an economy to stimulate? Okay, so recently we have seen that the Victorian government has canned the Commonwealth Games because they effectively have no money to be able to take on the project, and that's a critical sort of trigger point, or it's a data point that you should consider when we're going into a recession. Because in order for us to get out of recession in previous cycles, hundreds and hundreds of years ago, the government has to stimulate in some way. Fiscal policy, monetary policy, so dropping interest rates and spending money. What you can see here is that the central government debt to GDP ratio, so the size of the overall debt by your federal government compared to the size of the economy, China's only about a quarter. Japan, as we know, is well indebted, so it's over 2 times the size of its economy. The US is more than the size of its economy, and Australia is 70% of the economy is debt. And so when we need to print more money, the Chinese government is one of those places that's going to be able to stimulate longer term and more sustainably. Then you'd ask the question, okay, so that's nice, Jonathan, but we've recently seen that Chinese economic data has been weak. So what's the trigger point for the market to actually turn around? We consider the political cycle within this context. And what you see here on this screen is that it looks at basically the political meetings that occur from the National Party's Congress all the way through to the 6th, 7th plenum. And each plenum effectively means the next major government meeting that will occur. And we've seen that statistically speaking in previous cycles, obviously the bars that are going upwards above the line is positive returns and vice versa. You can see that statistically the 3rd, 4th, and the 4th to 5th plenum is where we generally see equity markets bounce stronger. And when is that going to happen in this particular cycle? It's sort of going to be between October and November this year. So if you're considering what the trigger point is, and a lot of people thought it was going to be this month, we actually don't believe it's this month because there is some political issues that's happening in China at the moment to secure people's positions. What we're waiting for is that next round of stimulus, which the government well knows it has to do, and we think it's going to be sort of October this year onwards. Because the argument is that the market's cheap. it is ridiculously cheap. So US equities is sitting at about 22 times earnings, which effectively means that it means that if you put $1 in today into the market, you need to wait 22 years to get your money back. In China, you can see on the left-hand side, it's somewhere between 5 years and 10 years to get your money back at the most expensive. And on the right-hand side, you can see the comparison between Chinese and US markets. The equity risk premium, basically the higher the number, the more expensive it is. The US is extremely expensive compared to China. So you want to be invested in places that are relatively cheap. And furthermore, I'm not going to go into this slide in detail, but what you can see is effectively this is an Australian report by the Strategic Policy Institute that looks at the 44 most powerful emerging technologies, and China is basically all but 7 of them. And furthermore, the Chinese consumer is more powerful now than any other country in the world, which is why you want to back those local brands, because the Chinese consumer now is actually investing more in local brands than foreign brands, which is the previous generation, sort of my parents. In terms of our geographical exposure and sector exposure, I leave you as the audience to sort of review that in your own time, but we do have a heavier weight at the moment to IT. We are not participating in the AI space because we think that it's too overvalued, and that's probably hurt us in the last 2 months in terms of performance. But again, because we're a relative value manager, we are just not going to pay expensive prices for things that we don't think provide long-term value. You can see our top 10 here, which I'll finish off my talk here. And what you see here is effectively we have a well-diversified portfolio of 94 different holdings. But the price to earnings ratio, which is said a reflection of how cheap or expensive the market is 9.6 versus the US market at 22, and even versus the Australian market at about 16. So with that, I'll pass it over to Angelina.
Thank you, Jonathan. We've got a few questions for you. And in your presentation, you talk about the Chinese market. Now, the Chinese property sector is about 25% of the economy. So what is the outlook for the Chinese property sector? And do you have any property developers in your portfolio?
So really good question. So a lot of people have raised the point around Chinese property, and that 25% that you talk about is effectively the entire value chain, right? So from builders to workers to suppliers, that's where that 25% comes from. So if the property market goes into turmoil, the rest of the economy generally is going to head in that same direction. That sort of what we call the Great Purge happened in 21, 22. And so all the bad developers have been cleaned out of the system. They're well gone. They're bankrupt or they're on life support. Almost, they're all going. Most of them are going to die. But what we're focusing on at the moment is actually the supply of new property. So at the moment, the last couple of months, we've seen property transaction volumes down, prices are down. The government's not actually allowing developers to drop the price on new property in China because they want to ensure that the land price and their ability to sell land to developers in the future retains at a good value. But the secondary market is falling. So what's going to change? Well, it goes back to demand and supply. There's no new properties being built, right? And when I mean no, I don't mean literally zero, but a lot lower. But the demand over time is still going to be there. So if you've got less supply of new property, but the demand recovers over time, then it's going to eat up the inventory, isn't it? Okay, because you don't build a property in a day. You build a property in 18 to 24 months. So what happens is that at the moment, the rough figures tell us that there's about 9 million units of demand longer term. Right now, China's only producing about 6 million units of new property each year, which means you've got a 3 million unit gap. And as this gap closes in, then what's going to happen is that price of primary or new properties is going to increase. But we think that's about a 2 to 3 year thesis at the moment.
And thank you for that. And my next question is, why is there so little exposure to India in your portfolio, and given how big the economy is?
Yeah, so we've got about 2% allocation to India, as you can see on the screen. One of the key issues that we've had with India is that there is 2 things that hamstring the economy. We think longer term it's an incredible economy, and we separate that from the investment argument. We're a relative value manager, and historically, when I said the US is trading on sort of 22 times earnings, Australia's trading at 16 times earnings, India has historically traded on average about 18 times earnings. So one of the problems for us as investors is as a relative value manager, is that do I want to pay up, okay, for that cost? Because the one thing that I would say that India has in favor of most other Southeast Asian countries, especially China, is the young population. It's sort of like 50% of the population is under 25. So there's a very big captive audience in terms of the consumer going forward. But it's too expensive. And at the same time, the level of government inconsistency on policy and effectively red tape and corruption means that we sometimes cannot see through how successful a project or an initiative a company is going to do without having to deal with a lot of that red tape. And that's not something that we see anywhere near as much of in a place like China. So India is expensive, and also, which is the primary reason, to be honest. But number two, we also see less or more opaque visibility on company successes.
Okay, well, thank you so much, Jonathan. Great to see you. Take care.
Thanks, Angelina.
Our last speaker of today's Global Perspectives is Mr. Grant Pearson from Insync Fund Managers. Insync's investment strategy is simple, but requiring great discipline and the ability to think differently. They're looking for large tailwinds that can propel them far ahead of whether their competitors or the markets assume. These are called Megatrends. Founded in October 2009, the fund invested in a concentrated portfolio of very large global companies. Key team members all invest alongside investors and are also shareholders of the firm. Grant's 31 years of industry accomplishment spans Australasia and North America, across both the buy and sell sides of the industry. His experience encompasses funds management, life insurance, investment banking, broking, and the retail advisory sectors. Grant's presentation topic is the global megatrends that impact you and your investments every day. Welcome, Grant.
Well, thank you. Over the next 10 or 12 minutes, I hope to give you a good insight as to why megatrends are so important for all investors, no matter who you're investing with. This first picture that you see on screen is of three lines. The bottom line, the green one, bouncing along there, that's the most overly used measure of what is seen to assess a good stock or not. It's called the price earnings or PE ratio. Now, the problem with them is that they're always looking backward in the rear view mirror. And if they do look in front, it's literally just to the front of the nose. They're not looking out long enough as to what's actually taking place in the world. So we are far less interested in what everyone else looks at. The other two lines, the blue one and that reddish purple line, is the price and the earnings of the market. And we can see a very strong relationship there between, as earnings grow, prices move along with it. Never in lockstep, but the trend is extremely clear. So our research has shown us over the decades that if we can find actual companies that exhibit that same relationship between earnings growth superior to everyone else, its stock price will follow, and hence it'll be superior to most others without taking loads of risk. So megatrends and where they come from is important because we're looking at the drivers of why stock prices do what they do. Let's move on to the 16 megatrends. Now, by definition, a megatrend is simply a bunch of changes and trends that coalesce together to create a very long-running, decade-plus trend of change, and they're unstoppable. They also don't respond one way or the other, really, to where interest rates are going. Are we going to be in a recession or not? Geopolitics, and all of those sorts of factors that most other investors concern themselves with. These things are massive and virtually unstoppable. Now, the 16 you see on the screen in front of you are the 16 investor-ready megatrends that we've identified around the globe. And today we're going to look at just two of them, and we're going to look at some of the companies we've invested in within those megatrends. So the bubble size is simply showing our particular exposure we have to each megatrend in the Insync portfolio. But why aren't they talked about? Well, megatrends are boring because they're like glaciers. It's like watching a glacier move. Are they powerful? Absolutely. But it's hard to see what change they've created until they've receded, and you can see the massive change and or destruction they've brought upon the world. Doesn't make great TV. It certainly doesn't keep up with the 24-hour news cycle. They're very important to us, however, because they help direct us where to invest in and where, importantly, where to avoid. As I said, they don't care about all the macroeconomics issues, and they're quite safe to talk about at your next dinner or barbecue, because they don't care much about the three things of race, religion, or politics. Let's look now at two examples. The title, Pet Humanisation, probably describes what we're getting at here. In the last decade or so, with much more to follow, we've seen a big change in how we relate to our animals. And if we are in the Western world with reasonable incomes and high urbanisation, we see a lot of factors occurring in this megatrend. Loneliness is probably the Western world's greatest negative affliction. We're having dislocated families, the rise of single households, and all sorts of things that are happening that makes animals more like a family member. In fact, if you don't say that to an owner now, they're quite offended, than just a dog or a cat or a horse or whatever. Now with that, there's a tremendous rise in the toys and trinkets and dog collars and dog bowls and food, even gourmet food for some reason. And so everything's rising. Now with that is the rise in medical care. And you've only had to have taken an animal to the vets recently to understand the price of that one. Zoetis that you see on this slide is a global pharmaceutical company specializing in veterinarian pharmaceuticals. Can you see the relationship here? We've got earnings and stock price trending upwards. But on the very right-hand side with the red line, you'll see what I call the rubber band effect. And that's a tension building when the stock price has gone so far out of line with earnings it wants to snap back. Now that's great when you're about to buy a company like this, because it's basically saying it's a great time to buy. But go back just a few years and you'll see that the price got away from the earnings because the market gets very exuberant. And then that rubber band tension builds again and it snaps back again. So at Insync, we don't mind jumping around each side of the earnings so long as the general trend is up, and the cause is markets and not the company itself. Slide is the Internet of Things, and all that is about is like the infrastructure behind this massive rise in computing, invading every part and every corner of our lives. Think of it like the power lines, the pipes, the roads, the distribution centers, the interchanges that enables high-tech technology. 5G is one that we've all heard of because of our phones, and it's part of this. But interesting, within 2 years from today, there'll be almost 42 billion interconnected devices on the globe. And it's only just beginning. So whether you're talking about transport or medicine or entertainment or food production, you name it, the Internet of Things is connecting everything together. The good news is it's just beginning. Now, if we take a look at a company you've probably never heard of that is doing very well from the stratospheric growth, it's called KLA Corp. Big global company. Effectively, they're selling the picks and shovels to the gold mining industry, in this case, the Internet of Things. So they sell services and widgets that help make all this happen. Now, they're well ahead of their competitors. And importantly, with all these quality companies we choose, they've got to be able to take a dollar that they earned last year and make 20% on it this year. And then keep doing 20% or better year after year after year after year. Now, there's very few companies that can do that. But look at the trend again between price and earnings. The red line shows the rubber band effect in play right now. And we've got a couple of other stocks in this megatrend, Qualcomm and Nvidia. You may have heard of Nvidia recently because it's risen 3 times in value in just 6 months. We got out about 2.5 times because our discipline tells us the price was running away too far in advance of the earnings. And so it's really important that discipline is left when we are looking at selling, that we don't get carried away. So what fuels these megatrends? What's the energy that creates all these changes and the creation of these trends? There are actually three. Now, whilst technology has been around since we hammered out the first wheel, since about 2007, a very important thing has happened. It's the first time in human history that the acceleration of the technology is changing at such a pace now, humans and society can no longer keep up with it. It's changing faster than we can understand it, debate it, and assimilate it. A great example was actually, I was just reading yesterday, Google. They have just put on their latest quantum supercomputer. There's only a handful in the world. It can now process information 270 million times faster than its old supercomputer that was around in 2019. So just in 4 years, what would have taken that supercomputer decades to do can take minutes now. So imagine that on the development of cancer drugs, on vaccines, just to name a few. Second is sustainability. Sustainability is really related to pollution. What it's sort of saying is where science and data beyond a reasonable doubt has said, look, for us to continue to thrive, we just can't keep doing it the way that we have. The world's resources is finite, and the ability of the planet to absorb all our activity is also finite. So we're talking about pollution of the air, the land, the water, biodiversity degradation, how we produce energy, growth at any cost mentality, all of those things as part of this whole change being driven by the fuel of the need to create sustainability. Last is demographics, the study of people. It's the who, what, where, and how of human activity on the planet. So for us, what does that mean? That says today's big consumers going to be the same type of consumers tomorrow in 5 years' time, 10 years' time. Has that changed from who it's been to date? Where do they live? What are their values? How do they live? All this is going to drive how companies, services, and products get made and delivered, and what profits and where they come from. So we are very, very interested in the world of demographics. Now, how do we bring this, find the highest quality companies? These companies, they're like mega super yachts in ocean racing. They have excellent leadership, amazing crews, high-tech boats, and they've got to be positioned in the right part of the ocean. The megatrends are like massive tailwinds that blow in that part of the ocean these companies have positioned themselves. And so together, they go well beyond everyone else for very long periods of time. The ability of those companies, as we talked, ROIC, that's just about that 20% reinvestment. Now, where megatrends and quality, high-performing, ultra-high-performing companies overlap, there's only about 150 on the globe. Out of the thousands, there's only 150. Out of that 150, all we do at Insync, after we've identified that, is we're selecting around about the best 30 that we think have the highest probability of exceeding everybody's expectations around the share price, without us having to do a lot of buying and selling. So I'll leave you on this, calamity protection. Most people investing in equity markets don't like it when the unexpected happens and markets plunge. Now, since 2009, when we started this fund, we've had 5 major unexpected crises where it was short, sharp, and severe. Now, what you look at in each of these 5 is in the blue is how Insync investors fared in the fund. The red is showing how the overall market performed during that period, and the green is simply the difference between the two. So what we're sort of saying here is that this is not a guarantee. What it is, it's more like a shock absorber. It's reducing the severity of the impact and the time you spend in it. Now, that's often important for a lot of people, or peace of mind, but especially retirees. In the first few years, you don't want one of these things happening. Otherwise, you're going to have to live on much less money for much shorter time. So for those that want the shock absorber protection, it is available. To leave you on a thought around our analogy with boats. Insync is all about identifying the best and most advanced teams on the best boats in the parts of the ocean that's going to get great big tailwinds to take them well beyond the rest of the fleet. We then have to be patient, stand aside, and let them do their thing.
Thanks, Grant. The megatrends are very interesting, but I got a question for you.
Yes.
Could an investor simply just find an ETF of stocks that match a megatrend and invest this way? Isn't that just easier and cheaper?
Well, if it was easier, it's most certainly easier. It's nowhere near as effective, though. If it was, we'd already be doing it ourselves. The problem is that companies do change, and the forces they're involved with and what they do, leadership can change. Exchange traded funds have much less ability for us to look under the underlying company. So whilst we are a stockholder, we think of ourselves more as part business owners. We invest in businesses, not stock prices. So ETFs don't give you the same utility and assurance that you can adjust it as time passes.
Thank you, Grant. It's great to see you, and take care.
Thank you very much.
For those watching our live stream, this is the end of the second day of the Investment Markets Investor Webinar. If you register for this event, you'll receive a link to watch the recording of today's presentations and Q&A later. Hope you find value in these topics today. We look forward to seeing you tomorrow, which is the last day of the webinar focusing on property and income perspectives. If you have any follow-up questions, please email us at events@investmentmarkets.com.au. Thank you. Bye-bye.